In this lecture, we are going to outline the 6 dimensions of a professional trading strategy and the difference between an amateur strategy and a professionally designed strategy. This is a necessary starting point that most retail traders get incorrectly, and therefore, they start their trading journey with the incorrect mindset about the market and how they are going to approach it. First, let's define the difference between an amateur strategy and a professional trading strategy. Roughly speaking, an amateur strategy is composed of a few tricks to get in and out of the market, and it doesn't have any sort of underlying principles that hold the strategy together in the long term. A strategy with this structure is certainly problematic, but it's not obvious why in a first moment. Since amateur traders usually lack the necessary depth of analysis about their trading ethics, they will relentlessly employ strategies with this faulty structure, and as a consequence, they will get frustrated with the results eventually. On the other hand, a professional strategy is composed of multiple minor strategies and it covers many different angles of analysis. In other words, a professional trading strategy has multiple strategies that are fully connected with one another and balance each other out. It also aims to provide a problem-solving framework instead of shallow rules to deal with inevitable problems that arise in trading. With that said, we obviously want to employ a professional trading strategy to achieve the best long-term results in our trading. This idea leads us to the recognition of the 6 dimensions of a professional trading strategy. The first dimension are the trading principles. These are the foundational aspects of a strategy that will guide the rest of the other 5 dimensions in the correct way. We will explore each trading principle individually in future lectures. For now, it is important to know the role these principles play in the 6 dimensions of a professional strategy. The next 3 dimensions are part of what is called the tripod of success. This metaphor serves the purpose of pointing out the fact that these 3 dimensions have a greater degree of connectivity between one another, and the whole strategy falls apart if any of them is neglected in some way. Just like a tripod falls to the ground if any of its legs is removed, a professional strategy falls apart if any of the dimensions of the tripod of success are corrupted in some way. These 3 dimensions are high-quality technical analysis, solid risk management, and deep trading psychology, which can also be called behavioral economics. It is interesting to notice the link between these 3 dimensions. For example, the intersection between technical analysis and risk management is what gives rise to the principle of good trade location, which is a foundational aspect of trading. In other words, it is impossible to trade using just technical analysis because the risk-taking approach becomes distorted and unrealistic. On the other hand, using risk management without technical analysis leads traders nowhere because we need to trade near the reversal points of the market, and the only tool we have for that is technical analysis. The intersection between technical analysis and trading psychology is also very important. Since high-quality technical analysis enables the trader to deal near the reversal points of the market, technical analysis plays an important role in diminishing the psychological pressure of having to risk more than what is necessary. The intersection between risk management and trading psychology is also deeply important and pragmatic. The correct application of the risk management mathematical guidelines enables the trader to operate within a relatively comfortable margin of error. This relatively comfortable state has the great quality of being sustainable for an infinite amount of time. That's the fundamental fabric of sustainable and consistent trading. The 5th dimension of a professional trading strategy is called operational logic, which is composed of certain tools that help improve the trade quality and manage particular trading situations with greater ease. The 6th and final dimension of a professional trading strategy is the trade plan, which is a compilation of rules and axioms designed to keep the trader on the right track. This last dimension has a profound importance due to the way the human brain is wired, as we are going to see in future lectures. These are the 6 dimensions of a professional trading strategy. Now we are ready to explore the first dimension in greater detail. In the next lectures, we are going to dissect each of the trading principles to truly understand their role inside a trading strategy. Contextual trading is a principle that dictates the trader must act when 2 or more trading techniques converge to the same point in the price chart. That's very important because any trading technique generates good and bad signals. When you have two or more different techniques pointing to the same area in the chart, you have a much better chance of producing a good trade. Another way of looking at this is that when two different trading techniques converge to the same point in the price chart, you are trading only the intersection between these two trading techniques. That's the best way of filtering out bad trading signals. Another attribute of contextual trading is the formation of a story for each trade. In other words, every trade must happen grounded on a few logically consistent reasons. Not just a simple setup. That's the best way to counteract the robotic and blind way of merely trading by following simple trading setups. Setups are important without a shadow of doubt, but they are incomplete if a trader doesn't take their context into consideration. The essential point is that every trade you make must tell a logical story to be justified. You cannot simply open trades because an indicator crossed over or because price has reached a support-resistance level. If it was that simple, everyone could become a professional trader in a short period of time. Let's increase the level of abstraction of our analysis and observe the contextual trading principle in its conceptual form. This picture is a good example of how contextual trading works in a metaphorical sense. When traders look at different trading signals from different techniques or theories, they are looking at true sides of the market, not at the truth of the market itself. By looking at the picture, we can see how analyzing one true side of the market can be misleading and ambiguous. If you had to guess what the tridimensional object was by just looking at one of its shadows, you could easily be misled. However, if you combine both shadows, you can arrive at a much more precise conclusion by deduction and elimination of contradictory possibilities. For example, if you were trying to guess what the tridimensional object in the room corner was just by looking at its orange shadow, your intuition would lead you to believe it was a cube. If you were to think a little deeper, you could arrive at the conclusion that it could be a cube or a cylinder, but the second option wouldn't be obvious at all. The same happens with the blue shadow, of course. However, if you combined both shadows, you would eliminate the possibility that the tridimensional object was a cube according to the orange shadow or a sphere according to the blue shadow. It's something in between. One of the tridimensional objects that fit both shadows simultaneously is a cylinder like the picture shows. The conclusion could be much more easily obtained by looking at both shadows contextually. Think of the market as a tridimensional object and the analysis techniques as the shadows. That's why we need multiple techniques working together to access the truth of the market, otherwise we're just blindly trading the shadows. By using this idea of converging techniques in context, the trader has a much greater chance of understanding what is actually going on in any given market. The reason we need contextual trading as a foundational principle is because of something called dimensional loss, which is what happens when we try to analyze a complex entity like the markets through the lens of a bidimensional price chart. The financial market is a multivariate and multidimensional complex system, and the trader only have bidimensional price charts to analyze it and extract useful information out of it. The price chart has one spatial dimension in the y-axis and one temporal dimension in the x-axis. The multidimensional market needs to be compressed and expressed in these two dimensions necessarily. That's called dimensional loss. This idea of dimensional loss is also correlated with something called Bonini's paradox, which serves the purpose to explain why single techniques don't work well by themselves. The Bonini's paradox claims that any attempt to explain a complex system like the markets become less understandable as it becomes more complete. In other words, since the market is a multivariate and multidimensional entity, any attempt to explain it fully becomes less understandable as it becomes more complete. The Bonini's paradox acts as a curse and a blessing in alignment with the dimensional loss of bidimensional price charts. At the same time that losing dimensions in the representation of price is counterproductive, it is the only viable and pragmatic option. The Bonini's paradox also points to the arrogance of thinking that one single indicator or technique is capable of fully explaining the market. In other words, by using setups or single techniques, a trader is assuming these tools have a much greater power than they actually have. However, this presumption is not at all obvious. We cannot fully explain the markets, but we can arrive at useful conclusions using the contextual trading and other principles as well. Part of this challenge is being able to recognize the human intention behind the price bars. This recognition of human intention can only be done by subjectively understanding the market, since it is formed by thousands of individuals with varying degrees of intention and power. To sum up, contextual trading is the gateway to the greater and deeper level of analysis that makes consistently profitable trading possible. In the next lecture, we are going to analyze the principle of multi-timeframe analysis. Multi-timeframe analysis is a trading principle that allows traders to increase their chances of finding a reliable trade opportunity by acquiring a broader and more sophisticated view of what's happening in the market. The idea that holds multi-timeframe analysis in place comes from chaos theory, and it's called fractal analysis, which can be extrapolated to all chart techniques in one way or another. Chaos theory is the theory that claims that apparently random and chaotic systems are not random at all. They just function within a higher degree of order that is not obvious at first glance. From that point of view, the appropriate way of analyzing a chaotic system like the markets is by breaking it down into smaller components. This is where the idea of fractal analysis comes into play. The word fractal means pattern that repeats inside itself. If we analyze the market under this light, we can actually start to make sense of what we see on a price chart because we can break down a complex system into smaller and simpler components that later will come together again to form a context for trading decisions. It's folk wisdom that price does the same thing repeatedly in all timeframes. The only thing that changes is the degree and the time it takes for these same patterns to develop. The fact that we can access multiple timeframes in our price charts is great, because that's how we can apply the concept of fractal analysis into our trading. This application has the effect of increasing the depth of analysis to a sustainable degree. Remember that the markets are a complex entity, so it is virtually impossible to know what is going on by taking a quick look at it. This idea of the fractal breakdown of price patterns really helps to pinpoint precise moments of likely reversal in price. For now, it is important that you understand that multi-timeframe analysis is the gateway to applying the fractal analysis to the markets. That's the case because by using multi-timeframe analysis, we can look at the same segment of price in different degrees. Let's observe a simple and conceptual example of what that means. For example, a large price movement analyzed only under the 4-hour timeframe doesn't show too much information about the smaller components of its internal trends. If we analyze the same price movement using a lower timeframe, taking into consideration the 4-hour timeframe as a contextual starting point, we can see multiple market edges that would not be visually available just by looking at the 4-hour timeframe only. However, a trader must be careful when using this idea because we can extrapolate it to extreme degrees, and it's not really obvious when it's the correct time to stop this extrapolation. That means that multi-timeframe analysis has its advantages, but it also has its disadvantages. For example, extrapolating this idea in too many fractals can lead the trader to something called analysis paralysis. Analysis paralysis is when the trader tries to make sense of too much information about the market up to the point where he freezes and doesn't know what to do. On the other side of the spectrum of analysis paralysis, we have something called objective blindness, which is what happens when the trader doesn't have enough information about the market. That usually happens when the trader tries to use simple indicators to smooth out the nuances of price data. The correct application of multi-timeframe analysis is supposed to keep the trader in the middle of this spectrum, where he has just the right amount of useful information to handle his trading ideas. It can be a little hard to understand these ideas conceptually if you have never messed with them in the practical sense, so don't worry too much about that for now. It will get a lot clearer when we move on to the practical examples. In the next lecture, we are going to explore the concept of hierarchy of trading signals between different timeframes. The concept of multi-timeframe analysis introduces the idea of hierarchy between trading signals among different timeframes. In other words, the technical signal in the 4-hour timeframe is stronger than this same signal in the 1-hour timeframe and all the lower timeframes below. Under this paradigm, a simple signal in the daily timeframe can sparkle a massive trend on the 5-minute, for example. That's why it is useful to pay attention to many timeframes to catch these unique opportunities. The term hierarchy implies a structure where one element is more important than another. That's exactly what it means for the trading signals generated by the many different techniques of our strategy. A good example of that is the application of support and resistance lines. If you find a meaningful support-resistance line on the 1-hour timeframe for example, this level can turn out to be incredibly important in lower timeframes. The reason for that is that larger market structures are composed of larger groups of traders ready to act in the same level. For example, if we find a meaningful support line on the daily timeframe, we can expect it to be more powerful than a support line in the 5-minute timeframe. That's the case because the magnitude of price movements in the daily timeframe is a lot greater and there are much more traders keeping an eye on it. With that said, when price reaches a level like this in the daily timeframe and we happen to be looking at a low timeframe, we can expect a dramatic reaction under the right context. To sum up, the essential point behind hierarchy of signals between timeframes is that the higher the timeframe, the stronger the signal. The lower the timeframe, the higher the level of market detail. This hierarchy of timeframes displays a trade-off between signal power and market detail. When we increase signal power, we always decrease market detail and vice versa. It's important to point out that this idea works for any technique as well. In the next lecture, we are going to explore the principle of trade location. Displaying good trade location simply means trading near the reversal points of the market. That's what every trader is after at the end of the day. Not necessarily only the major reversal points, but the minor ones as well. Trading near the reversal points of the market means you will have a small stop order and a potentially large take-profit target. This concept obviously goes hand in hand with risk management, the idea of risk-reward ratios and overall expectancy, which are paramount for the trader's survival in the long term. The best way of trading with good trade location is by using contextual trading and multi-timeframe analysis. Without good trade location, it is virtually impossible to trade consistently in the long term because the ultimate attributes of risk-reward ratios simply don't work without trade location. Let's see a conceptual example so this idea becomes a little clearer. Think of the extremes in price as market edges. As traders, we aim to trade as near as possible to these edges. That way we can guarantee that we can have a tight stop-loss order and a potentially large take-profit target. This idea of small stops and large targets is the backbone of solid risk management, and all the other more complex ideas regarding risk spiral off this notion. The other interesting thing about trade location is that it's only possible to achieve it with high-quality technical analysis like you are learning in this course. Standard technical analysis and the shallow use of technical indicators are not capable of enabling the trader to acquire good trade location. There are two reasons for that. The first is that the simple application of technical indicators usually involve a great degree of lag and the obfuscation of market nuances. The second reason is that the application of linear smoothing algorithms in price data usually produce bad results because price data is nonlinear. By simple application, I mean the application of indicators without the more sophisticated layer of fractal analysis. Indicators can be useful if they are used in the correct context and if they are layered with advanced principles like the ones you are learning here. In the next lecture, we are going to explore the principle of relative recognition of market movements. The idea of multi-timeframe analysis and fractal analysis open the gate to the relative recognition of market movements, which is basically the notion that a sideways market in a large timeframe is composed of many trends on a small timeframe. This is a useful idea because it can determine how long traders will aim to stay in a trade. It also provides a broader view of the market being analyzed. The relative recognition of trends can be useful to produce trades that are highly profitable and have a good risk-reward ratio, which is what traders should be aiming for. In this strategy, you will learn the necessary tools to view the market in this broad sense and to pinpoint the precise entry and exit points of high-quality trade opportunities. Let's see a conceptual example of the relative recognition of market movements. Imagine that you have a sideways market in the 1-hour timeframe. The basic premise of the relative recognition of market movements is that a sideways market in one timeframe is composed of many trends in a lower timeframe. With that in mind, a trader can strive for trading only trending markets by choosing the correct timeframe to trade. The motivation for this can come from the fact that trending markets can be easier to trade because of the larger momentum sustaining price movement in one direction. In this example, we can see that the sideways market represented in black price vectors is composed of several trends that would be easily traded on a lower timeframe. We can take this idea even further and realize that there can be sideways markets inside larger trends as well. For example, a consolidation movement within a large trend in the daily timeframe can form a clear sideways market in the 1-hour timeframe. The essence behind this idea is that no matter where we are in a price chart, we can look at it at different angles and using different perspectives. These different perspectives might help you determine the overall context of your trade. The relative recognition of market movements is a strange idea, and it is a form of cognitive parallax, which can be viewed as the dissonance between theory and practice. The segregation of the market between different timeframes is an illusion. The market is an abstract entity, so when we divide it into separate timeframes, we get this weird cognitive parallax effect that happens to be quite useful for different reasons. Cognitive parallax can be better defined as the difference between the theoretical thinking axis and the experienced axis of a trader. In other words, the theoretical axis of a trader observing the market can tell him that a certain market movement is a trend or a sideways market at the same time. This perception depends on two main variables that shape the trader's interpretation, which are the magnitude of price movements and the temporal framework in which they happen. However, that's merely a theoretical construction of the trader in question. The actual experience of this trader is a lot simpler than this. The market is either going to go up or down. The interesting thing about this is that another trader might have a completely different theoretical view of the market, but he is obviously going to experience the same market independently of being right or wrong about it. For example, Trader 1 might be analyzing the market and thinking it is in a sideways mode, therefore he adjusts his analysis to conform with this type of market. Trader 2 might be thinking that this market is in a clear downtrend, therefore he adjusts his trading ideas to conform with that interpretation. Both traders can be right and make money simultaneously. That's called complementarity, which is when two apparently contradictory outcomes happen to make sense in reality. This idea explains why two traders with opposite views of the market can both end up being right about it. The complementarity effect happens because of the boundaries of cognitive parallax in the market, which are magnitude and the temporal framework of any given market movement. These two elements that surround the cognitive parallax are only possible because of the rather convenient timeframe segregation of markets. Once again, cognitive parallax is the dissonance between two different theoretical explanations of the same market. This weird effect of cognitive parallax is quite useful because it gives the trader the possibility to recognize a good trading opportunity in many ways. This ends up increasing the likelihood of success of an educated trader. By the same token, this decreases the likelihood of success for the uneducated trader because this whole idea can become quite confusing in practice. To sum up, the relative recognition of market movements is a useful tool to frame your trades using the multi-timeframe analysis of the market as a foundation. The practical effect of this idea is the increased number of available trading opportunities to the trader who understand these concepts well enough. In the next lecture, we are going to explore the principle of subjective interpretation of the markets. The subjective interpretation of markets can be seen from two different angles within any reliable trading strategy. There is the subjective interpretation of technical setups and sensitive market variables like the interpretation of price action and the power of the overall context. There is also the subjective interpretation of risk that all traders need to deal with when trading real money. We all have the same biases and we are run by the same software when it comes to dealing with economic decisions involving risk, probability, and time. However, our personalities vary greatly and the way we respond to these biases also varies significantly. Every trader is a unique individual with finely calibrated intuitions about the market and overall risk. That simply means we need to recognize these differences and work to extract the best out of them. That also means that the trader is a unique part of the trade plan, and if the trader doesn't learn how to deal with a certain level of subjectivity in the markets, no trading strategy will be able to produce good results no matter how good the strategy is. It is important to clarify why traders need some degree of subjectivity in their analysis. This happens because the financial markets, as we already pointed out in previous lectures, is a multivariate and multidimensional entity, and it is virtually impossible to roll back the chain of causality of price movements completely. That's the central point of the subjective interpretation of markets and its practical necessity. As we already saw in previous lectures, the representation of the market in bidimensional price charts has the effect of dimensional loss, and that makes impossible to roll back the chain of causality of all market movements. Consequently, part of the trader's analysis must come from a subjective interpretation of price. This is arguably the most difficult thing about trading. Since the price charts provide limited information, traders need to develop a market intuition based on price nuances. A perfect example of that is observing the relationship between the candle body and the candle tails. A trader cannot see the complete chain of causality of what happens inside every candle, but by observing the visual relationship between candle body and tails, the trader can subjectively arrive at useful conclusions about what happened inside this particular candle. Subjectivity in the conceptual sense is how an individual installs his intuitions about a given subject. This is closely related to the limited conscious bandwidth of our analytical power and the overwhelming amount of information that can be derived from the charts. The presuppositions a trader must make about the market are larger than his conscious bandwidth because the market's chain of causality cannot be fully rolled back due to the dimensional loss of price charts. This is a rather uncomfortable idea to most traders because everybody is after a completely objective and mechanical way of trading that eliminates the uncertainty out of the process. It's important to notice that it is impossible to trade in that way because of the things we are exploring in this lecture. There is no comprehensive market analysis without some degree of subjectivity. Once again, that's the case because of the complexity of the markets plus the limited tools a trader possesses to derive meaningful information out of it. It's interesting to notice that a great deal of how the market looks like in a chart is due to the subjective interpretation of millions of traders around the world. The structure of price is formed by its objective representation in a price chart, which is the nominal price you see in your screen, and its subjective interpretation, which is the perceived value of that nominal price. One of the forces that drive the markets up and down is the discrepancy between the objective price and the subjective value of any given market. For example, if most traders in the market look at the nominal price and they subjectively assume this price is higher than their perceived value of the market, price tends to fall because these traders will feel like the market is overpriced and they will open sell positions. By the same token, if most traders in the market look at the nominal price and they subjectively assume this price is lower than their perceived value of the market, price tends to rise because these traders will feel like the market is underpriced, and they will open buy positions. The bottom line is that to achieve the necessary level of complexity to produce high-quality trades, a trader must use some degree of subjectivity to read the intentions behind the price bars. As you will learn later in the course, there are several ways of doing this by looking at the way price action behaves. In the next lecture, we are going to explore the principle of interdependence between the strategy dimensions. The final trading principle that we are going to analyze is called interdependence of strategy dimensions. That basically means that all 6 dimensions of a professional trading strategy must be fully connected to one another for the strategy to work properly over time. That principle is also applied to the trading principles themselves. As it was already pointed out a few times during the course, the foundational trading principles are the base of the strategy. Every other subsequent dimension of the strategy must dwell inside the guidelines and concepts already outlined. This idea might seem overwhelming at first, but it is necessary that you study these things carefully, so they become second nature to you. One of the things you will realize about real-time trading is that the less information you have to distract you, the better it is for obvious reasons. However, the impulse to keep things simple when it comes to analyzing the market must be approached with a considerable amount of caution. In other words, as far as trading goes, things must get a little complicated before they get simple. The conclusion is that all these ideas and concepts must become second nature to you, and they serve as an automatic lens through which you begin your analysis. If you need to think too hard about them, that's because you might have not understood them well enough yet, and you should go back and review them until you feel comfortable enough to explain these things to someone else. With that said, the trading principles form the foundation out of which the rest of the 5 strategy dimensions will be born. The next 3 dimensions under the label of tripod of success have interesting intersections that are worthy to point out more expressively. Let's begin by looking at the intersection between technical analysis and risk management. These 2 dimensions are obviously related, and that's a primal intuition even for a new trader. Everybody has a primordial intuition that one should pay attention to how much one risks and how that correlates with where one is opening trades in the chart. We already went over the concept of trade location, which dwells at the heart of the intersection between technical analysis and risk management. For risk management to work in the way we will learn later in the course, having good trade location is an absolute necessity. The tool that enables a trader to reach the level of good trade location is high-quality technical analysis. By high-quality technical analysis, I mean the type of market analysis that is multi-layered and has more degrees of complexity than the standard technical analysis that most traders learn. Next, we should point out the intersection between risk management and trading psychology, which is a deal-breaker for most traders in the market. As you will learn in the trading psychology portion of the course, the human mind is full of cognitive traps that can turn trading into a rather uncomfortable activity if the trader doesn't have the correct guidance. This is especially the case if the trader doesn't use sophisticated risk management tools. The problem is that most of the psychological pitfalls encountered in trading are unavoidable, meaning that it is almost impossible to bypass them completely because they are so deeply embedded in our behavior. That's where risk management shines because it assures the trader will avoid entering the slippery slope of amplified emotions in trading. This is done by different mathematical mechanisms inherent to the way risk functions in the market. A good example is the margin of error that can be obtained by uniting good risk-reward ratios with good trade location. The intersection between technical analysis and trading psychology is somewhat similar to the intersection between risk management and trading psychology. High-quality technical analysis gives the trader a sense of peace of mind once he understands how close he can trade to the edges of the market. That's paramount because the constant feeling of doubt about entering too early or too late in a trade can severely damage the psychological aspect of trading in a moment-to-moment basis. The operational logic and the trade plan dimensions are the most pragmatic of all 6 dimensions because they put practical constraints and boundaries to what a trader can and cannot do. This is important for many different reasons. As we will see in the trading psychology portion of the course, the human brain has 2 modes of operation roughly speaking. One of them is incredibly counterproductive while trading, and it gets amplified if the trader doesn't have a pre-written plan for certain situations. The other mode is necessary to build the analysis and the pre-written plan, but it's deliberative and its weakness is its ability of acting. The bottom line is that we need both of them at different times, and we need to train ourselves to know when and how to calibrate them effectively. This lecture closes the first part of the course that explores the foundational dimension of a professional trading strategy. In the next lectures, we are going to explore the technical analysis dimension. In this lecture, we are going to explore the main differences between the standard technical analysis that most traders use in the market, and the high-quality technical analysis that you are going to learn in this course. There are important differences between the two. First, we should clarify that technical analysis is the trader's only weapon to access what's going on in the market using price charts. Technical analysis can usually be divided in 2 main categories. The first is the raw price action analysis. The second is the use of technical indicators to process the raw price data in the attempt to extract useful information out of price. The price action analysis itself can be divided in 2 subcategories, which are the price nuance reading and the various types of lines that a trader can draw on a chart like Fibonacci levels, pitchforks, channels, support resistance lines and so on. Here is where the problem of standard technical analysis begins. The initial impulse of new traders is to cluster their screens with many different technical indicators. That's usually done by naively assuming that each technical indicator provides a qualitative value that other technical indicators don't. That's false. Most technical indicators are basically smoothing algorithms. In other words, most technical indicators attempt to smooth out the noisy and raw price action. The need to smooth out price data comes from the confusion a trader feels when he stares at an apparently chaotic price chart, which is normal when the trader is not used to deep price analysis. However, this impulse goes precisely in the opposite direction of what the trader should be aiming for. A price chart is already a limited source of information. By smoothing out price, the trader is losing even more information. One can argue that it is useful to observe the relationship between raw price and a smooth line on a chart, which can certainly be the case sometimes. However, the trader needs to be careful about how much he is going to rely on smoothed price data. I am calling your attention to smoothed price streams like in a moving average, for example, because of the Bonini's paradox we saw in earlier lectures. Once again, the Bonini's paradox states that any formula to describe a complex system like the markets becomes less understandable as it becomes more complete. That means that a reliable smoothing algorithm should be almost impossible to understand due to the complexity of the markets, especially its nonlinear nature. However, if we look at indicators' formulas, we will notice that they are incredibly simple. A simple moving average, for example, is just an average of the last x values of raw price. By the light of the Bonini's paradox, a simple algorithm like a moving average is useless to derive useful information out of the market. On the other hand, since the markets are complex, and many traders have learned to look at moving averages and respect their role in the markets, a trader sometimes can use these simple algorithms in very specific situations. The point I'm trying to make here is that from a theoretical point of view, trying to smooth raw price action is usually a bad idea because we tend to lose useful information in that way. A good example of that is grounding your trend bias in a moving average angle. Since moving averages are smoothing algorithms, they produce a considerable amount of lag. The immediate effect of using this as a method to determine the trend is that you are always going to be behind the market, not ahead of it, which is precisely the opposite of what you want. It's also important to point out the trade-off between lag and smoothness in technical indicators. If you want to increase the level of smoothness in data, you will always increase the amount of lag. Basically, the smoother you get, the more lag you generate. There is some debate about trying to increase smoothness at the same time lag is decreased, and that can be done to a certain degree, but not to the point where it becomes useful. Another problem with smoothing price action is that we need to choose an arbitrary period value to feed the smoothing algorithm formula. For example, we need to choose the period of a moving average. By doing that, we are assuming that this value is equally applicable to all market scenarios, and that is a serious mistake. That's the case because price action is nonlinear. In other words, it is impossible to box the market within a linear formula. That's why moving average crossovers work sometimes and fail others in an unpredictable way. Beyond that, price action has something called temporal unpredictability of nonlinear shifting. In simpler terms, if we were able to describe the market with a formula, this formula would change from time to time. Worse than that, the frequency in which this formula would change would be unpredictable as well. That's the starting point of the Bonini's paradox. As you can see, you must be careful if you want to apply formulas in price action. Another way of looking at the financial markets that is useful to really grasp its complexity is through the lens of chaos theory. The financial markets are a chaotic system of the second order, which means it's a system that responds to prediction. The fact that when somebody tries to predict the market they are contributing to make the system even more complex doesn't really help predicting it. Another example of chaotic system of second order is the political system. A good example of a chaotic system of the first order, which is where a prediction doesn't affect the system, is the weather. The problem is that the financial market functions by a pure system of supply and demand, and like most productive endeavors, it is bound to the Pareto principle. The Pareto principle states that a small minority of people will produce most of the outcome in any given system. For example, a small minority of soccer players score most of the goals. A small minority of artists produce most of the music that is heard on the radio. The financial market is no exception, so a small number of traders will make most of the money. The Pareto principle is the main driver behind inequality of outcomes. Some people might argue that this is an inherent flaw of the capitalist system and its supply and demand mechanism, but if we look at communist or socialist systems and their distribution of power, we will notice that the inequality of outcome is even greater in practice than in capitalist systems, which is exactly the opposite of what the theory that critiques capitalism states. The bottom line is that the Pareto principle seems to be a fundamental law that drives human endeavors. Another way to look at the Pareto principle within the context of the financial markets is that the traders who have more money tend to make even more, and the traders who have less money tend to make even less. The point I'm trying to reach here is that there are traders with an incredible amount of capital power, which is enough to tilt the markets at specific points. If you combine this idea with the fact that the financial markets are a chaotic system of second order where the predictions alter the system, you will arrive at a scary conclusion. The conclusion is that there are traders powerful enough to maneuver the vast majority of retail traders in the market through reverse psychology techniques. These techniques work within the context of the most well-known concepts of technical analysis and the most relevant cognitive biases of the human mind. However, there is a time and a place for that. In this lecture we are focusing more on the main differences between good and bad technical analysis. Let's create a comparison chart to observe these differences more clearly. The first difference is that good technical analysis doesn't rely on smoothed price streams too much. We are certainly not going to add 7 different technical indicators in our charts. The second difference is that good technical analysis usually takes fractal analysis into consideration. This idea is closely correlated with the use of the trading principles that we studied in previous lectures, which are completely ignored by the bad side of technical analysis. Good technical analysis worries about reaching the truth of the market through well-constructed contexts, while bad technical analysis has an overly optimistic and pragmatic preoccupation with setups and tricks to enter the market. Good technical analysis tries to go in the direction of price-action noise with the intent to find its underlying order, while bad technical analysis tries to obfuscate price-action noise in a naive attempt to turn a nonlinear dynamic into a linear dynamic through simple formulas. Good technical analysis respects the Bonini's paradox, while bad technical analysis is completely alienated from it. High-quality technical analysis also takes into consideration the Pareto principle and the fact that markets are chaotic systems of second order. Bad technical analysis assumes the markets are a completely leveled playing field where all market players have equal power. Now we are ready to explore the specific techniques that are going to be used in this trading strategy. In this lecture, we are going to do a quick overview of the techniques contained in the fractal flow strategy. The techniques are born out of the combination of momentum divergence or momentum asymmetry with the fractal analysis of the markets. The idea of divergence is used only in its shallowest form by most traders because they are not aware of the other half of the process, which is the fractal analysis of momentum. When we combine momentum divergence or asymmetry with fractal analysis, a few new and more precise techniques arise. These techniques are called fractal reversal divergence and fractal hybrid divergence. These techniques can happen in what we call degrees, which are determined by the number of fractals in which these techniques happen. The fractal reversal divergence and the fractal hybrid divergence also give rise to an interesting price-action technique called fractal bar, which is a special type of candle formation that enables the trader to see these momentum discrepancies in one single bar and often without the need to change timeframes, which is rather convenient. Along with these more advanced techniques, we are also going to overview the classic types of divergence called reversal divergence and hidden divergence, and we are going to see how the combination of these different types of divergence in different fractals form the more complex techniques that dwell at the heart of the fractal flow strategy. We are also going to explore the auxiliary technical analysis tools that serve the purpose of enriching the context of our trading ideas. These techniques are the support and resistance lines and the price action reading on a bar-by-bar basis. Support and resistance lines can be either horizontal or sloped lines. The price action reading on a bar-by-bar basis is divided into 4 categories. These categories are the relative volatility, bar shape interpretation, relative bar position and bar quality. These are the technical analysis techniques that we are going to be exploring in the fractal flow strategy. However, before we begin exploring each technique, we need to understand the relationship between price action and momentum. The price chart has two axes. The y-axis represents the spatial dimension of the market where we can see price fluctuations in terms of magnitude. The x-axis represents the temporal dimension in which price fluctuations occur. The combination of both axes enables us to see the fluctuations of price over time in an organized manner. However, when we look at price charts, we often get the impression that there is a hidden force driving the market, and we cannot really tell what this force is doing most of the time. We can only see its reflection on price volatility somehow. We call this hidden force the market momentum, which can be defined as the invisible market inertia or the net result of buyer power against seller power. The tricky thing about the impression of market momentum is that it can be misleading most of the time. For example, price might be rising ferociously without too much momentum behind it. On the other hand, price might display low levels of volatility with a significant degree of momentum behind it. The thing is that we can observe a synchrony between price action and its perceived momentum. There are two possibilities. Price can be coordinated or out of sync with its apparent momentum. This is where the idea of divergence was born. Since we have a few indicators to measure market momentum, we can see this discrepancy happening in a more tangible way. The classic technical indicator used to measure momentum is the relative strength index, which has the advantage of displaying the magnitude of market momentum independently from raw price action. Notice that we are not trying to smooth price action with the relative strength index. We are trying to create a visual representation of market momentum with it. That's in agreement with the Bonini's paradox that was outlined in previous lectures. Once again, we are not attempting to find a linear formula for the market momentum. We are simply trying to catch the moments where raw price action and its measurement of momentum seem to be out of sync by mathematical standards. That's the best we can do to measure market momentum. It is worthy of noticing that the relative strength index was attributed with some functions it is not capable of performing over the years due to the experimental nature of technical analysis. One example of this is the idea of overbought and oversold levels in the relative strength index, which is a too bold and ambitious idea to say the least. This indicator is built in a fixed scale, so it naturally produces distorted levels because it's trying to reflect price, which is not represented in a fixed scale. This idea of overbought and oversold levels is clearly bad because of this. However, the idea of divergence is a good one because we can take the relative strength index weakness and turn it into a useful tool. Divergence is a very common idea in the markets, and many traders give up on it because this idea by itself is useless, especially in the way it is usually presented in technical analysis manuals and so on. The idea of divergence is good, but it is hugely incomplete without the extra layer of fractal analysis and the understanding of how to perceive the different market flows. Just as a parenthesis, many traders commit the mistake to look for the all-powerful technique of the markets, and they inevitably end up being frustrated in their search. That's common in the markets because a lot of people have an inherent drive to find a quick and simple technique that will turn trading into an easy task. Traders with that kind of mindset are basically shooting themselves in the foot. By using a one-dimensional technique and expecting it to behave like a multi-layered tool, the trader is assuming this simple tool has a lot more power than what it actually has. This is a paradoxical behavior, and unfortunately, it is highly intuitive because we have cognitive biases that drive us to find the simplest solutions to our problems, which are not always considered to be the best solutions. Most traders don't like the idea that the markets are complex, so they immediately gravitate towards the notion that the smart thing to do is to keep things simple as far as the market analysis goes. Ironically, that behavior is the opposite of being smart about the market. Unfortunately, the market cannot be compressed down to the level of univariate tools. The variable that needs to adapt is the trader, not the market. In other words, the trader needs to adapt to the level of complexity of the markets instead of the market adapting to the level of simplicity of our primitive biases and need for cognitive comfort. Divergence is a popular technique, but since many traders insist in this unreliable mindset I've been describing, they never end up accessing the true power of this tool, and of many other tools for that matter. With that said, simple divergence by itself is a poor tool. We need to take this idea to the next level of complexity through the lens of fractal analysis and combine it with other good tools to form a good strategy. Divergence is just a way of visualizing the discrepancy or asymmetry between raw price action and its perceived momentum. Since we are going to explore this idea in its full potential, we are also going to analyze its weaknesses, so you can have a good idea of the precautions you must have with it. Let's analyze a few conceptual examples to understand exactly how we can measure momentum and divergences by comparing the highs and lows in price action with the highs and lows in the relative strength index. First, we should point out that there are two modes in which price can be in. The fluctuations in price action can be coordinated with its perceived momentum or out of sync. When price and momentum are coordinated, price action creates a higher high or a lower low, and the relative strength index also produces a higher high or a lower low. That basically means that price is displaying the same amount of momentum that is being measured by the relative strength index. When price and momentum are out of sync, there are two distinct situations that can happen. The first and most common of them is called a reversal divergence. The second situation is called a hidden divergence. A reversal divergence when price is going up happens when price creates a higher high and the relative strength index creates a lower high. That basically means that price is going up, but it has a low amount of momentum sustaining this movement. If the divergence is legitimate and not simply a distortion in the way momentum is plotted on the chart, price will reverse after it. By the same token, when price is going down, a reversal divergence happens when price makes a lower low and the relative strength index makes a higher low. Needless to say, this works in the exact opposite way of an upward market. The hidden divergence is the opposite of the reversal divergence because instead of signaling a reversal, the hidden divergence signals a continuation in the overall movement of the market. In an upward movement, a hidden divergence occurs when price makes a higher low, and the relative strength index makes a lower low. The logic behind this is that the price seems to be reluctant to display the same amount of magnitude observed by the plotted momentum. In a downward movement, a hidden divergence occurs when price makes a lower high and the relative strength index makes a higher high. This is where most of the traders in the market stop learning about divergence. However, we are going to take these two types of divergence and we are going to layer them together in different fractals to see the results. As it was pointed out already a few times, the way to do that is by using the idea of fractal analysis, which is going to be explored in the next lecture. In this lecture, we are going to take a closer look to the idea of fractal analysis and what it means in a conceptual form, so we can have a better understanding of its practical applications later in the course. The key to grasp the idea of fractal analysis begins by knowing what the word fractal means. We can define a fractal pattern as a pattern that repeats inside and outside itself in multiple degrees. The name of the fractal flow strategy comes from the idea that we can always observe separate market flows in different fractals, and these flows go in and out of coordination on a constant basis. To bring this idea to a more pragmatic approach, in any given timeframe, we can observe at least two market fractals. By market fractals in this case, I mean sets of highs and lows that appear to be in the same degree. This is an important observation because sometimes is not so clear in which fractal a market movement is. That's one of the reasons why we studied the subjective interpretation of price as a foundational principle. However, this problem will be explored later in the practical examples. For this lecture, we should only worry about the idea of market fractals and fractal analysis in general. To facilitate this notion, let's first define the idea of market vectors. Market vectors are the building blocks of highs and lows, and we can define them as the vector that come out of a high and end in a low or vice versa. Let's begin with a simple example. Imagine a simple upward market movement that we can call market vector. What you will notice is that this larger vector is formed by smaller vectors like you see in this conceptual example. These smaller vectors are also formed by even smaller vectors. This idea goes until the smallest market element, which is the tick or the smallest possible variation in price. This lens of fractal analysis is what creates the possibility to triangulate exact points of entry and exit in the markets by watching how different market flows interact with each other. This idea can be conceptually expressed in a more condensed way using the circle paradox. Imagine that you are looking at a two-dimensional circle from a given distance, but as you look closer, the circle begins to look like a polygon with a very large number of edges. The paradox dwells on the notion that the geometric figure is a circle and a polygon simultaneously depending on how far away we observe it. Fractal analysis is what makes it possible for us to see the edges of the market by breaking it down into its smaller components, so we can view this idea as a metaphorical magnifying glass. By being able to see the edges of the market, we can see where the market stops to reverse into the next move. This idea is a double-edged sword because it enables us to access a greater level of analysis, but it makes it a little bit more complex than what we would like. This complexity comes from the confusing nature of market flows, which are composed of market vectors that go in one direction. For example, an upward market flow is composed of higher highs and higher lows. However, within these higher highs and higher lows, we have downward movements happening in lower fractals, and even smaller upward movements happening in an even smaller fractal. These market flows often collide with each other. The job of a trader is to make the correct judgment about the strength of each market flow, and which one will dominate the next movement of the market. This is why we use the hierarchy of trading signals as a foundational principle in our trading. This is also the reason simple divergence without the more sophisticated layer of fractal analysis won't work properly. In other words, without fractal analysis, there is no real point of reference in terms of the perceived power of the signals generated by the relative strength index. However, the more complicated aspect of fractal analysis lives on the collision of market flows. The recognition of fractal divergence is relatively straightforward. We will explore the dynamic of market flows more deeply in another lecture. For now, it's important for you to grasp the overall idea of what fractal analysis means. The next step is to understand how to apply the layer of fractal analysis to the study of momentum divergence. That way we can derive two more sophisticated techniques called fractal reversal divergence and fractal hybrid divergence. These two new techniques will later give rise to another price action technique called fractal bar. In the next lecture, we will explore the fractal reversal divergence concept in greater detail. In this lecture, we are going to explore the first advanced technique derived from the combination of simple divergence with fractal analysis through the gate of multitimeframe analysis. If we take the concept of fractal pattern that we studied in the last lecture, and apply it to the idea of simple divergence, we will arrive at an interesting idea. Since a fractal is a pattern that repeats inside itself, a fractal divergence is a simple divergence that happens within another simple divergence. The other conclusion is that this idea can happen in multiple degrees, so we can have maybe 3 or 4 simple divergences happening within one another, which increases the level of accuracy of our entry and exit points in the market. To be able to see this happening in a chart, we need to define the notion of divergent price territory, which is what will enable us to look for smaller divergences in smaller fractals. Divergent price territory is when raw price action and momentum are out of sync. For example, when price makes a higher high, and the relative strength index fails to make a higher high, we enter in price divergent territory in an upward movement. The opposite is true for a downward movement, of course. At this point, we can go to a lower timeframe to find another simple divergence happening within the already divergent price territory. When we find a simple reversal divergence happening inside another divergence, we call this pattern a second-degree fractal reversal divergence. When we find 3 simple reversal divergences happening within one another, we call this pattern a third-degree fractal reversal divergence. Let's conceptualize the fractal reversal divergence to solidify our understanding of the idea. To identify a fractal reversal divergence in at least 2 fractals, first we need to observe a simple reversal divergence happening in real time. Once we identify that, we draw a rectangle to point out the divergent price territory for the lower timeframes. After that, we jump down to the next lower timeframe and wait for another simple reversal divergence to occur inside the divergent price territory outlined in the higher timeframe. That's the basic framework of a fractal reversal divergence. If you wish to identify fractal divergences with higher degrees, all you need to do is to repeat the same steps again. A third-degree fractal divergence would happen when you were able to see a simple reversal divergence within a divergent price territory, and this divergent price territory would be inside yet another divergent price territory. If you study this idea in your price charts, you will notice that fractal reversal divergence is capable of pointing out extremely precise points of reversal in major and minor fractals in the market. However, now that we already know the strengths of the concept, let's explore its weakness. The fractal divergence concept is a good idea, but let's not forget that it still comes from a simple technical indicator. For example, if you decide to use the fractal divergence concept by itself, which is a bad idea, you will notice that sometimes price appears to be in a reversal point in a textbook example of fractal divergence, only to find out that price will mislead you, and continue in its original direction for a few more vectors. This is precisely the reason we studied the contextual trading principle. In other words, you cannot trust the fractal divergence idea by itself. It is merely a precision tool that needs to be used in the right time. However, we have an operational logic guideline that helps traders in these situations. Often when you see a floating fractal divergence without any other techniques pointing to the same area, you can assume that price is playing a subtle sleight of hand, because you will often find fractal reversal divergences happening in a lower fractal that agree with the overall trend. Remember that it is always much easier to trade in the direction of the trend. The right time to use the fractal divergence will be defined by the context of the trade. For example, if you happen to see a fractal divergence in the same price level where major support resistance lines are agreeing with the analysis as well as the raw price action reading, you can think about forming a trade idea if the potential risk parameters of the trade agree with the concept of long-term sustainability, which we will explore in later lectures. In the next lecture, we are going to explore the fractal hybrid divergence idea. In this lecture, we are going to take a closer look at the fractal hybrid divergence, which is an idea derived from the collision between fractal analysis, hidden divergence, and reversal divergence. The hybrid in the name of this technique is a reference to the fact that it uses a blend of two techniques that are not usually used together. The term fractal obviously means that the hybrid divergence can only be recognized with the extra layer of fractal analysis. As we studied in previous lectures, a hidden divergence signals a continuation in the overall movement of the market, which is a safer place to start our chart analysis rather than looking for price reversals. That's because trading with the overall flow of the trend is a much safer and less risky endeavor than trying to pick up the ultimate price reversals. The fractal hybrid divergence is an accurate way of catching unique momentum asymmetries in price by layering two opposite techniques together. Once again, this is only possible by using the concept of fractal analysis to find these opportunities. The fractal hybrid divergence is composed of a hidden divergence in the higher timeframe or in the higher fractal, and a reversal divergence in the lower timeframe or lower fractal. Just like the fractal reversal divergence, the hybrid divergence can appear in multiple degrees. It's worthy of noticing that only the first degree of the fractal hybrid divergence is composed of a hidden divergence. All the subsequent degrees you will be able to spot have the reversal divergence structure. Let's try to conceptualize this idea in a clearer way. The first step of spotting a fractal hybrid divergence is identifying a hidden divergence in what you are going to call the higher timeframe. Here we can use the same concept of divergent price territory that we used in the last lecture. Once you determine the divergent price territory, we can jump down to a lower timeframe to try to spot a reversal divergence inside this territory we marked in the higher timeframe. From this point on, the fractal hybrid divergence works exactly like the fractal reversal divergence. The difference lies in the beginning of the process. In other words, in the fractal reversal divergence we only use reversal divergences that repeat themselves in various degrees. In the fractal hybrid divergence, we start the analysis by identifying a hidden divergence, and then we use reversal divergence in all the next degrees. As you can probably imagine, the fractal hybrid divergence is not as common as the fractal reversal divergence, which makes it an even higher probability trade idea. The moments in which this technique appears are truly one of a kind, especially if they have a logically consistent context surrounding the technique. In the next lecture, we are going to study a brand new price action technique called fractal bar that can only be derived from the study of fractal divergence. It is impossible to reach the conceptual idea of the fractal bar without understanding everything we have learned so far in the course. In this lecture, we are going to study the price action element called fractal bar or fractal candle depending on your preference. The fractal bar is a concept that can only be achieved by studying the different techniques under the fractal analysis and the precise relationship between the peaks of the relative strength index and the peaks of price. There is a lot more going on in price and momentum extremes than what meets the eye. Roughly speaking, the fractal bar is a way to spot a second-degree fractal reversal divergence without jumping between timeframes. We do that by analyzing the precise alignment between price peaks and the relative strength index peaks. That's the way this is done because a divergence in a lower timeframe has some effect on the relative strength index of a higher timeframe. However, this effect is very subtle, so most people simply gloss over it, and therefore, miss the opportunities that come along. To be more precise, when we talk about the alignment between price and momentum peaks, we need to understand the idea of momentum offset. Most of the time, the price extremes align exactly with momentum extremes in the relative strength index. When a fractal bar appears on the chart, the momentum peak is slightly offset to the left. That basically means there is a reversal divergence happening in a lower timeframe. That's quite useful because it diminishes the need to jump between the timeframes so often while maintaining the benefits of doing it. It's a win-win situation. We call the bar in which this momentum offset happens the fractal bar. This bar doesn't need to have a specific relationship between its body and tails necessarily. It's more about the momentum offset observed. However, as we are going to see in future lectures, if a fractal bar has some attributions that agree with the context of a hypothetical trade, it's an even more powerful technique to have in the arsenal. It's relevant to point out that fractal bars spiral off from the idea of fractal reversal divergence, but they can appear within the context of a fractal hybrid divergence that has 3 degrees or more. If you studied the last lecture well enough, you will understand that this can happen because, from the second degree and below, fractal hybrid divergences are exactly the same as fractal reversal divergences. For example, we can have a fractal hybrid divergence by spotting a hidden divergence in the 4-hour timeframe and a fractal bar in the 1-hour timeframe. In this case, it would be a third-degree fractal hybrid divergence because the fractal bar represents 2 degrees, and we obviously have the first degree coming from the hidden divergence. If these ideas seem confusing to you at the moment, I suggest that you go back to the previous lectures and study them a few more times. By doing that, you will be more prepared to move on to the next lecture where we overview a series of real market examples of the fractal flow strategy techniques. In this lecture, we are going to introduce the idea of auxiliary tools that help enrich the context of our trades. The auxiliary tools we are going to use in this course are the 2 types of support and resistance lines and the nuanced price reading, which aims to detect the subjective interpretation of the relationship between candle body, candle tails and candles themselves in various situations. The combination of these tools with the fractal flow strategy techniques, and the notion of market trends that we are going to explore in future lectures is absolutely critical for the successful construction of a good context for your trading ideas. To trade successfully in the markets, you will need to find moments in which all these techniques and tools agree with each other. That's the best way of finding high-probability opportunities. In the next lecture, we are going to explore the 2 types of support and resistance lines and their attributes. In this lecture, we are going to examine the important idea of support and resistance lines in its 2 variations. The most common of these variations is the horizontal type. The less common, and perhaps more powerful variation is the slope type. Before we go into greater detail about the more advanced use of these important lines, let's overview the basic structure that holds this concept in place. Support and resistance lines are basically barriers that price tends to respect based on the idea of market memory. When traders analyze the recent past of price, they tend to look at price extremes as areas where buyers or sellers might show up again. That happens to be the case many times. The other common attribute of support and resistance lines is their switching dynamic. For example, if price encounters a support line, tests it a few times, and then zoom it down, this support line switches from support to resistance because price is now below the line, and it has already been tested as a valid barrier for price. The opposite is also true, of course. If price encounters a resistance line, tests it a few times, and then zoom it up, this resistance line switches from resistance to support because price is now above the line, and it has already been tested as a valid barrier for price. Another attribute that is worthy of pointing out is the fact that such lines can act as a barrier, but they can also act as a catapult for price. For example, if price decides to break a support-resistance line, it will do that with an increased volatility most of the times. We call this movement a zoom through the line. This is the basic framework of support and resistance lines. Now let's move on to a more complicated idea, which involves the principles of multi-timeframe analysis and the hierarchy of signals. Previously in the lecture, we talked about the idea of market memory, and how this is the underlying principle that holds the idea of support and resistance lines in place. However, the notion of market memory is relative to the temporal observation of the market. For example, in the daily chart, a support-resistance line might come out of a high or low that happened 20 days ago. On the other hand, a meaningful support-resistance line on the 5-minute chart might come from a high or low that happened only 1 hour ago. This basically means that the power of these lines is attached to the temporal framework in which they appear. The cool thing about using contextual trading, multi-timeframe analysis and the hierarchy between trading signals is that we can use support-resistance lines from higher timeframes to build a trading context for lower timeframes. The true advantage comes from the hierarchy between trading signals. To understand this idea, just imagine the power of a support-resistance line that comes from the 4-hour timeframe on a context built for the 5-minute timeframe. The line drawn in the 4-hour timeframe has a lot more power attributed to it, so it might sparkle a more violent reaction in lower timeframes. With that said, we can advance this principle even further by understanding the less common application of support-resistance lines, which is the sloped or angled type. Sloped support and resistance lines work under the exact same principles as the horizontal type. The only difference is that these lines have to be drawn in some sort of angle to fit under this category. The possibility to draw sloped lines that function within the same axioms that sustain the idea of horizontal support-resistance lines poses a huge potential. That happens because by drawing such sloped lines, we can find many different market angles that would simply pass unnoticed otherwise. The idea of sloped support-resistance lines gives rise to the idea of energy points in price. An energy point is a level where two support-resistance lines with different angles meet. That can happen when a horizontal line meets a sloped line or when two or more sloped lines meet in a common point. The idea of energy points is that when they converge to the same point or level, they produce an amplified effect on the attributes of common support-resistance lines. These energy points can be useful to place target orders, for example. Another interesting property of sloped support-resistance lines is the fact that we can extend these lines to other important highs and lows in the market respecting the angle in which they were originally drawn. This is a powerful technique that might greatly enrich the context of a trade and point out to the edges of the market with an almost perfect precision. However, these types of lines have their downside. Since a trader can find an incredible amount of these in any given market scenario, the trader should be careful in selecting the lines he is going to use in his context formation. There is a large set of lines that can be found in the market at all times, but only a small subset of these lines is valid. The antidote to this problem is to reverse engineer the context by using these lines after some other converging points between other techniques have been found already. By doing that, you can select only the lines that seem to be more relevant to your context. Keep in mind that we are only looking at the concept behind the support-resistance lines. These ideas must be implemented in practice in order to be fully understood, as we will do in future lectures. In the next video, we are going to explore the idea of price action reading within the context of bar or candle interpretation. In this lesson, we are going to study price action reading within the context of candlestick reading. This is probably the most challenging part of the course because it involves the principle of subjective interpretation of markets. I say that it can be difficult because sometimes it's hard to come up with a black and white answer about what a candle means exactly. That happens because we cannot fully roll back the chain of causality of the decisions made within a candle period. We need to interpret the candles based on a few assumptions of what the relationship between candle body and candle tails mean. It's paramount to note that an enormous effort has been made over the years to box candlestick in a series of pre-packaged patterns, which is an attempt that has diminishing returns. For example, the same exact candle can mean different things in different contexts. Even worse, it might not even mean something useful if it is isolated and doesn't fit within a trading context. That basically means that memorizing different names for certain candlestick patterns is counterproductive. We need to approach price action reading in a more organic and flexible way. Instead of memorizing the name of a candlestick pattern attached to a pre-packaged interpretation of what it means, we are going to establish a few guidelines that will enable you to come to your own conclusions about what candles mean in whatever context they might appear. In order to do that, we need to establish 4 different angles in which we are going to analyze specific candles on the chart. The first angle is called relative volatility, which is the perceived volatility of the candle being analyzed in relation to the surrounding candles. High volatility candles are simply larger than low volatility candles. However, this idea of larger and smaller depends entirely on the frame of reference. For example, the candle X can be considered high volatility if compared to candle Y as a frame of reference. However, it can be considered to have low volatility if compared to candle Z as a frame of reference. Recognizing the relative volatility of a candle is important because that indicates moments where buyers or sellers start a significant move. This moment by itself can be used later on as a non-obvious level that will compose a trading idea. The second angle is called shape interpretation. This is where we attempt to roll back the internal history of a candle by looking at the relationship between its body and its tails. This combination of body and tails is what forms the abstract idea of candle shape. There is no better way of grasping this concept other than practicing. In this lecture we are going to see a few conceptual examples. Later in the course we will observe the real application of these ideas. The third angle of price action analysis under the light of candle interpretation is called relative position, which points to the position of the current candle in relation to the previous candle. This is where the notion of inside and outside bars comes from. An inside bar is when the entire candle being analyzed is constrained within the range of the previous candle. An outside bar or outside candle is when the range of the candle being analyzed completely engulfs the previous candle. Once again, without the temporal frame of reference, it is impossible to determine if the candle has an inside or outside relative position. The fourth angle used in candle interpretation is called bar quality, which is simply the determination of which market player dominated the bar. That's a straightforward analysis because a candle in which the close is higher than the open is dominated by buyers. A candle in which the close is lower than the open is ultimately dominated by sellers. Let's practice these 4 angles in a few conceptual examples, remembering that the complete understanding of how to interpret price action only comes from practicing it a lot. In candle 1, we can notice that it has a lower volatility than the previous candle, which shows the market slowed down at least for the candle in question. By looking at the shape of this candle, we can see that it has a large body and small tails. This can be interpreted as a sign of dominance of one type of player in this candle. It also shows an idea of certainty because there is not much evidence for the activity of the less dominant market player in this candle. However, if we look at the relative position of this candle, we can see that it is completely constrained within the range of the previous candle. This idea changes the interpretation we have so far a little bit because an inside bar doesn't agree with the idea of dominance of one market player over the other. This can lead us to believe that the sense of dominance achieved by looking at the first 2 angles of the analysis could be shallow. Under the light of the fourth angle, we can see that this candle is a bullish candle and the dominant market player were the buyers, of course. By looking at these 4 elements, we can form a bias about what this candle might mean in a trading context. Keep in mind that we are looking at only 2 candles with no other element influencing the analysis, so there is only so much information we can obtain here. Let's look at a more interesting example. Here you can see that the relative volatility of the candle in question is a lot higher than the previous candle. This shows an increased interest in the market. However, the really interesting analysis comes from the shape interpretation of this candle. Here we can see that this candle has a small body and an unusually large upper tail. One interpretation that can be achieved here is that buyers were stronger than sellers at some point inside this candle, but ultimately the sellers dragged the buyers down near the end of the candle. Another possible interpretation, which is slightly different, is that buyers were consistently stair-stepping the market up until they reach a point where they opened a door and saw angry sellers ready to bring the market down violently. These two interpretations vary slightly, and a more precise interpretation would require more information coming from other price action elements. The relative position of this candle in question is also interesting. We can see that it is an outside candle, which helps to confirm the power of the sellers involved in this candle. Last but not least, we can see that this is a bearish candle, which in this case is rather obvious, but there are situations where the candles will give you mixed signals about the market player who was dominant in the candle. For example, a mixed signal here would be a bullish quality in this candle, which would contradict a little bit the interpretation of the other three angles. In the next lecture, we will start to understand how to analyze market flows and market trends. In this lecture, we are going to study how we can approach the market in order to determine its trend. As it is usually mentioned, determining the trend of a market is quite useful because trading with the flow of the overall trend is a lot easier than trading against it. To begin understanding how to read the markets and the proper way to establish the trend, we need to grasp the concept of market structure. The market structure is composed of undeniable facts that a trader can read on a price chart. These facts relate to relationship between buyers and sellers in the market. The fundamental unit of measure of market structure are the market vectors. In other words, the vector between a high and a low or a low and a high. When we look at the charts, we can observe a series of market vectors and determine that they form patterns. For example, when price makes higher highs and higher lows, we observe the market vectors stair-stepping up. If we look at this idea more closely, we can see the logic behind this intuition of uptrend that comes from higher highs and higher lows, and also the intuition of a downtrend that comes from lower highs and lower lows. We can view the highs as the ultimate attempt of buyers to drive the market up, and the lows as the ultimate attempt of sellers to bring the market down. In an uptrend, the buyers are stronger than sellers, so they can produce higher highs. In a downtrend, the sellers are stronger than the buyers, so they can produce lower lows. That's an incredibly simple idea, but that's the fundamental nature of how price behaves on a chart. However, as you are about to find out, simple does not necessarily mean easy because of the fractal nature of the markets and the inherent level of complexity attached to the chain of causality of price. This complexity begins to show its face when we first recognize that there are multiple types of players in the market. In other words, there are traders with different amounts of capital power looking at the charts in different timeframes. This variation is what makes the simple mechanism of buyers and sellers complicated to observe sometimes. The problem is that we can usually see different herds of market players in the same chart. This brings us back to the notion of the flows in the market. In one single timeframe, we usually can observe at least a major market flow and a minor market flow. This touches in one of the hardest problems of trading, which is identifying where these flows shift and the hierarchy of power between them. Remembering that fractal means pattern that repeats inside itself, we can try to identify different market flows in the same timeframe. This is where the principle of subjective interpretation of market comes into play. Two different traders counting major and minor highs and lows on a chart might arrive at different conclusions about which highs and lows belong to the major flow and which highs and lows belong to the minor flow. It's important to notice also that there is a hierarchy of power between the major flow and the minor flow of the market. This relationship is mediated by what we call market memory, which is how much past information the current market remembers and respects. This is relative to the timeframe under analysis, of course. That's a tricky part of analyzing market flows because sometimes the minor flow will have more power than the major flow, and that is due to the interference of market memory. This is a situation that many traders have experienced in one way or the other. For example, imagine that you build a context for your trade idea by looking at the most obvious highs and lows on the chart, which usually come from the major flow. When price finally arrives at the place you were expecting it to have one type of reaction, you get caught by surprise because the market is the exact opposite of what you predicted. The reasons for this is the lack of attention in the minor flow and the failure to understand that the highs and lows you have used to form your context are not part of market memory anymore, so the minor flow seems to win over the major flow. Once again, understanding this subtle flow-shifting nature of the markets is one of the most challenging aspects of trading, and it is also a critical one. The identification of a flow shift in the market depends on several contextual factors, so the better you are at building trading contexts and reading the market organically, the better you are going to be at identifying these subtle flow changes. Another critical aspect of market structure is the notion of confirmed market structures and fake market structures, which recognition depend entirely on the candlestick reading of the highs and lows. This is also paramount to understand because most of the times, we will use only confirmed market structure to place our stop-loss orders. The logic behind that is quite simple. A confirmed market structure, as it was alluded in the beginning, is an undeniable fact in the charts. For example, a low is only confirmed when price surpasses the last high. By the same token, a high is only confirmed market structure when price surpasses the last low. That's fine, but there is a very important catch here that adds another layer of complexity to this story. Sometimes, price surpasses the last high or low, but it doesn't close above or below it. In other words, price only pierces the level in which a market structure would be confirmed. This is often the work of market makers who are attempting to employ their manipulative maneuvers on unadvised retail traders, which is a deeper subject that is outside the scope of this lecture and it will probably be explored in another video course. That brings us to the notion of fake market structures, which is when price only pierces the level that is supposed to confirm the last high or low. As the name suggests, we cannot rely on these types of structures as a solid place to put a stop-loss order because most of the times, these fake structures are made to be broken, so putting a stop-loss near them is a bad idea. By now you must be able to recognize that the simple mechanism of highs and lows in the market creates a few challenges that are not so simple. We need to pay attention to the different flows of the market and the points where they collide. We need to make the correct judgments about the hierarchy between the major and minor flows, and we need to classify the highs and lows of the market between confirmed and fake market structures. Keep in mind that in this lecture, we are only exploring the conceptual part of what we should be paying attention to in a chart. It's difficult to condense all the nuances of the practical application of these ideas into their purest forms because the markets have many different scenarios, and these ideas happen in many different ways. Once again, the best way to study these things is by observing the way they happen in real charts, which is what we will do in the lectures that contain trading examples. In this lecture, we are going to make a brief introduction to the incredibly important and necessary idea of risk management. As it has been mentioned quite a few times in this course so far, it is impossible to become a consistently profitable trader in the long term without applying the basic principles of risk management. Most traders who enter in the market have a primal intuition that making money consistently is all about having very high win ratios. As you might have probably experienced for yourself, it is extremely hard to sustain a high win ratio over long periods of time due to the nature of how markets change from time to time. This means that over the long run, the win ratio of a professional and consistent trader will not be as high. However, that's perfectly okay because we have the amazing mathematical properties of risk-reward ratios to help us as traders achieve the best results in the long term, which is the only thing that matters after all. It's pointless to have good performance in the short term if you are unable to sustain it for an unlimited amount of time. You don't want to be the kind of trader who makes money super fast, but loses all his earnings even faster. It's never enough to stress out that risk management cannot function properly without high-quality technical analysis and deep trading psychology, otherwise we would be able to make money by opening random trades in the market, and we know that this is not the case. For us to collect the benefits of the risk-reward ratios, we need to be able to trade near the edges of the market and we need to train our minds to support losses without triggering certain emotional pitfalls. The first goal is controlled by technical analysis. The last is managed by trading psychology. Without any further ado, let's move on to the lecture that deals with the idea of risk-reward ratios. In this lecture we are going to explore the central element of risk management, which is the risk-reward ratio. The risk-reward ratio is simply the ratio between how much a trader risks and how much he expects to earn in a given trade. In other words, the ratio between the stop-loss order and the take-profit order. By the way, this is one of the reasons it is important to know your targets before you enter a trade. If you don't have any idea where your target might be, you cannot define the risk-reward ratio of your trade, and therefore, you cannot judge if such trade has enough headroom to become a high-quality trade. The risk-reward ratio is so important because it guarantees that we will expect to earn more than what we risk not only in each given trade, but in the long term as well, which is really critical. This brings us to the concept of expectancy, which can be defined as how much a trader can expect to earn in each trade based on the average risk-reward ratios of his past trades. This is why some modes of trading that completely dismiss risk-reward ratios easily fall apart over time. For example, a trader who is after immediate and small rewards and moves his stop-loss a lot to accommodate his biases is silently producing an expectancy lower than 1. This is a deadly mistake for a few different reasons, but the most basic one is that mathematically and statistically speaking, all this trader is doing is expecting to earn less than what he risks, which obviously makes him lose money in the mid and long terms. There is also a severely toxic psychological feature attached to this type of trading because, in the short term, this trader will feel great about his small and subsequent rewards. He will feel like he is really building something great. The problem is that a trader cannot go around the laws of mathematics, so in the mid and long term, it becomes less and less likely that this trader will be able to maintain a high win ratio. In fact, there is too much hype around the idea of win ratios. As you will find out in this course, a trader can make money being wrong most of the time in his decisions, as long as he maintains other aspects of the strategy intact. Before digging deeper into the study of how risk-reward ratios function and their amazing mathematical attributes, let's solidify the idea of expectancy first. Once again, the expectancy of a trading strategy is the average of the risk-reward ratios used in all past trades. For example, in this two tables you can see the risk-reward ratios used in the last 5 trades of 2 trade samples. If we discover the average of these ratios, we will arrive at the expectancy of this strategy. Notice that in Table 1, the strategy uses ratios that range between 1 to 3 and 1 to 5. In Table number 2, the ratios are below 1 because the trader has no real rules on how to manage risk and basically improvises his stop and target decisions based on instinct, which is a really bad idea as we will study later in the trading psychology section of the course. If we take the average of both tables, we can see that Table 1 has an expectancy greater than 1, and Table 2 has an expectancy lower than 1. All this means that the trader using the strategy number 1 can expect to win more in the long term. Meanwhile, the trader producing the strategy number 2 can expect to make less than what he is risking in the long term. In other words, he can expect to lose money in the long term. However, there is a cynical catch at play here. In the beginning of both strategies, both traders will have completely different mindsets. Trader number 1 will probably be a little disappointed because his win ratios won't be that great. However, Trader 2 will be building his confidence to dangerous levels due to the high win ratio of his strategy. This is a very misleading exercise. Trader 2 is not aware that his high win ratio only exists because his targets are too close to his trade entries and his stops are too far away. This configuration tends to produce a high win ratio in the short term, but it is doomed to fail over time because, at some point, the market will go against Trader 2 and he will be stopped out. That will wipe out most of his small profits and he will be emotionally devastated. On the other hand, if Trader 1 is capable of being mature enough to know that a high win ratio is not necessary to make money in the long term, he will continue on his path to become consistently profitable over time. This is a perfect example of what trading really is. This is also a lot like the old story of the tortoise and the hare. The hare is too fast, and it burns itself out too quickly. The tortoise slowly but surely gets where it wants to go. That does not mean that Trader 1 cannot have peaks of performance. The better the performance, the better it is for your capital of course, but high performance must occur within a certain framework that will guarantee its sustainability in the long term. After all, nobody starts trading with the goal of making money quickly, and then losing it all even faster. The bottom line regarding the notion of expectancy is that your expectancy level should be higher than 1. For this lecture, it is important that you understand how the idea of risk-reward ratios dwell at the heart of risk management, and how it affects the trader's behavior in the short and long terms. In the next lecture, we are going to look at the margins of error that risk-reward ratios provide, and we are going to define the best range of ratios in which you should maintain your trades. We already have a firm grasp on the idea of risk-reward ratios and overall expectancy of a strategy, which comes from the average of ratios produced over a certain period. The expectancy is a good metric to measure the risk health of a trading strategy. In this lecture, we are going to look at a more specific attribute of risk-reward ratios, which is the margin of error that they offer. For each level of risk-reward ratio, the trader obtains a percentage of margin of error in which he can rely on. For example, if you trade consistently using a ratio of 1 to 3, you can be wrong 75% of the time in your trade decisions and break even. That happens because for every profitable trade you can make 3 losing trades and break even. Let's see the mathematics of that in a quick example. Imagine, for simplicity's sake, that in every trade you make, you risk 1% of your capital and you expect to win 3% in return. We clearly have a risk-reward ratio of 1 to 3. Imagine also that you have made 2 profitable trades in a row, producing a 6% return on your capital. Since you lose only 1% of your capital if you are wrong in your decisions, you can be wrong for the next 6 trades. Imagine that you end up being wrong in the next 6 trades and you end up breaking even. Let's calculate your win ratio. You made a total of 8 trades and you lost 6 of them. In other words, you were wrong in 75% of your trading decisions, and your win rate was only 25%. By using a good ratio like 1 to 3, you were able to protect your initial capital even while being wrong 75% of the time, which is a lot. Let's look at the different margins of error for the different ratios so we can take this whole analysis to the next level. Here we can see something interesting. As we increase the ratios, the margin of error obviously increases, but the size of the increment decreases. We can observe that by calculating the increment in the margin of error obtained with each ratio. For example, a 1-to-1 risk-reward ratio gives us 50% of margin of error while a 1 to 1.5 risk-reward ratio gives us 60% of margin of error. The increment between these two levels is 60% minus 50%, which results in a 10% increment in the margin of error when we jump from the first level to the other. If we plot the increment column in a chart, we will notice that a decreasing logarithmic curve appears. In practical terms, this means that in the beginning of the table, the increment we get with each risk-reward level is high. After a certain point, the increment in the margin of error starts to get smaller and smaller while the risk-reward levels increase arithmetically. If we want to have some sort of statistical edge in the markets, we must choose a range of risk-reward ratios that is realistic at the same time it provides a good margin of error. In the beginning of the curve, the margins of error are not so good. More towards the end of the curve, the margins of error are good, but the ratios are unrealistic in a trade-to-trade basis. That does not mean that making a trade with 1 to 10 ratio is not good. It's just not realistic to expect that in every trade. Most of your trades should live within the 1 to 3 to 1 to 5 ratio, but occasionally you will find exceptionally good trades that will stand out, and that's perfectly fine, of course. The ability to trade having a good and realistic margin of error is the most important aspect of risk management because that's precisely what guarantees a certain level of emotional stability and peace of mind for the trader. That's because the trader will not feel the pressure of being right all the time, and he will still be able to make money. This risk configuration also avoids the bad psychological cascading effects that can happen when traders attempt to be correct all the time, as we will see in future lectures. The essential point of this lecture is to show you the optimal range of risk-reward ratios and how we conclude that this is the optimal range. In the next lecture we are going to explore the idea of risk contraction and expansion. In this lecture we are going to learn an idea that serves the purpose of leveling the trading playing field in terms of risk-taking. It's not an absolute necessity to employ the techniques of risk contraction and expansion, but if you want to obtain the full effect of the margins of error of the various risk-reward ratios, you need to level the risk you take in all trades. In real-life trading, the size of your stop losses will vary. That means that the good properties of risk-reward ratios can get a little distorted to the worse side of the spectrum. For example, imagine that you have this series of 4 trades. You can see that the size of the stop-loss orders varies quite a lot in terms of pips. The largest stop is 30 pips and the smallest one is 5. If you end up being right on the smaller trades and wrong in the larger trades, your margin of error can suffer. This is where the idea of risk contraction and expansion comes into play. The goal behind this idea is to use leverage to make all trades risk the same percentage regardless of the stop size. That way, no matter how large or how small the stop-loss orders are in terms of pips, you will always risk a fixed percentage of your account. You can have a clearer view of your margins of error in that way. Let's see how we can calculate the trade size with a simple formula. The formula is quite simple, and it goes like this. The trade size in lots equals the arbitrary risk in terms of capital divided by the size of the stop-loss in terms of pips divided by 10. To discover the arbitrary risk in terms of capital, we need to know our equity and we need to define an arbitrary risk percentage. For example, let's say that we have $100,000 and we want to risk 1% of that in each trade. Our arbitrary risk in terms of capital equals 100,000 times 1%, which is $1,000. We divide that number by the size of our stop-loss in terms of pips, which is 20 in this example. Then we divide that number by 10, because we know that one standard lot has a pip value of $10 per pip. The formula returns the amount of lots we need to purchase in order to make our trade risk exactly 1% of our equity with a 20 pip stop loss. Let's do the reverse calculation to prove our formula. We know that one lot gives us $10 per pip. The formula returned 5 lots, so our trade would function with $50 per pip. If we got stopped out, we would lose 20 pips at $50 per pip, which gives us a $1,000 loss, which is 1% of our equity. This is how you can quickly calculate the size of your trades if you wish to level the playing field in the way that we described in this lecture. In the next video, we are going to talk about different methods of position sizing and how you can grow your account in an organized way. In this lecture, we are going to explore 2 different methods of position sizing. Position sizing is how you manage your trade size in order to grow your equity in the most efficient way possible. There are many different types of position sizing methods, but we are going to explore 2 simple methodologies that tend to yield the best results and don't require complex mathematics to calculate the size of your positions. The first method is linear, and we must establish an equity threshold to change the size of our positions. For example, if we establish that our threshold will be 100%, we will only adjust the size of our positions once our equity has doubled. In other words, when it has achieved 100% return. We also need to establish an arbitrary risk level or arbitrary amount to every trade we make. Here you need to decide if you are going to use risk contraction and expansion as it was explained in the last lecture. Let's create a hypothetical example to illustrate how the linear threshold method would function. Imagine that we have an equity of $10,000. In this example, we will use risk contraction and expansion, so we will define our arbitrary risk percentage as 1%. That way, every trade we make will risk 1% of our equity regardless of our stop-loss size. Our threshold will be 100%, so when the account reaches $20,000, we will adjust the size of our trades again, but not until it hits this threshold. 1% of $10,000 is $100, so in every trade we make under the linear threshold method, we will risk $100 until we hit $20,000. Once the threshold is met, we adjust the size of our trades to 1% of the new equity, which is $20,000. From that point on, we will risk 1% of $20,000 until we reach the next threshold of 100%, which will be $40,000. The established threshold can vary, of course. The lower the threshold, the more risk you will be taking, and consequently, the faster your account will grow. However, remember that more risk can also mean larger losses, so be fully aware of that before you decide on which position sizing method you will use. Remember also that you should not use an arbitrary risk that is too high. The reason for that is that the more risk you assume, the more you will be bound to suffer from an amplified state of the cognitive biases that we will be studying in future lectures. The less risk you take, the easier it will be for you to deal with your losses and to manage your emotions in real time. The ideal scenario is for you to find the optimal arbitrary risk level in which you feel comfortable enough to open a trade when the opportunity appears, but you also don't get overwhelmed by amplified emotions. If you want to use the linear threshold method without risk contraction and expansion, you will need to determine a fixed amount to open your trades based on your available margin. That is correlated with your available account leverage, but as a rule of thumb, you should not use more than 5% of your available margin. The procedure regarding the adaptation of the trade size is similar to the example where we use risk contraction and expansion. The only difference is that without risk contraction and expansion, instead of defining an arbitrary risk percentage, you will define an arbitrary margin percentage for your trade. For example, let's imagine that you have $10,000 in an account with 1 to 200 of leverage. You also defined your arbitrary margin percentage as 3%. Since you will be using 3% of 10,000 at 200 of leverage, you will be purchasing 60,000 units, which gives you $6 per pip. Once again, these numbers are completely arbitrary because they depend on your subjective experience of risk. Just remember to not exaggerate because you want to make money fast. That's never a good idea. The other position sizing method that we will be exploring is an extrapolation of the linear threshold method, and it's called moving threshold. Consider that every time you close a position, you have a new threshold, which is the available equity in your account. This can also be viewed as risking a fixed percentage of your available equity in every trade. This is a more aggressive approach that can work for or against you depending on your performance. All you need to do is to establish an arbitrary risk percentage for your trades and make sure that all trades fit that arbitrary value, just like you learned in the risk contraction and expansion lecture. For example, let's say you have $25,000 and you want to risk 3% of your account every time you make a trade. All you need to do is use the risk contraction and expansion formula you learned in the last lecture to adjust the size of each trade. The main difference between the linear threshold and the moving threshold method is the nature of how the arbitrary threshold shifts. The method that you are going to use is completely up to you due to the subjective nature of how each person interprets risk and your tendency to be risk-seeking or risk-aversive. In the next lecture, we will be exploring the idea of shooting stops forward as a method of relieving the pressure of constant risk-taking in the market. In this lecture, we will study the idea of shooting stops forward, which is a way of viewing risk-taking in a way that diminishes the psychological pressure that comes from constant risk exposure in the market. It serves also as a psychological weapon that aims to neutralize the bad emotions that come attached to a losing trade. Trading is not an easy task and traders are far from being perfect because we have many silent psychological flaws. That reality poses a challenge to the trader who responds too negatively about being wrong in his decisions. As we already learned, consistently profitable trading can and will probably be done being wrong most of the time, which is a practical necessity due to the way risk-reward ratios work together with the idea of trade location. However, the great advantage of using the correct risk-reward ratios gives us the possibility of being wrong most of the time, as we already saw in previous lectures. In this video, we will extend this idea a little further with the concept of shooting stops forward. When we risk our capital in the market, especially if we use risk contraction and expansion, we expect to win a certain amount and we expect to lose a certain amount that seems tolerable to us. If we view every trade as a summation of stops, we can have an objective mechanism to create a positive psychological effect that diminishes the bad feeling of losing and regulates the good feeling of winning. Let's suppose that you use risk contraction and expansion, and you risk 1% of your capital in each trade. Instead of viewing that risk as a 1% risk, you can view it as a one-stop risk. You are risking one stop expecting to make 3 or 4 stops with your targets. If the first trade you make is a winner, you can be wrong for the next 3 or 4 trades depending on the ratios you use. If you start with a losing trade, you know that all it takes is one good trade to neutralize the losses generated by 3 or 4 bad trades. The idea of shooting stops forward is quite simple. You simply count how many stops you earned as a reminder of how much you can be wrong without losing capital. For example, let's imagine a hypothetical situation where you win and lose trades in an alternating manner. This won't happen in reality, of course, but it serves to show you the idea of shooting stops forward. With each trade, you count how many stops you earned the right of being wrong in the future. That gives you peace of mind to continue risking your capital without the fear of losing the next trade just because you lost the last trade. That's incredibly important, as you will find out in practice. In the next lecture, we will begin the study of the trading psychology section of the course. In this lecture, we are going to make a brief overview of the topics contained in the trading psychology section of the course. At this point, it's almost a cliché to say that trading psychology is absolutely necessary for any trader to not only survive, but to succeed in the long term. However, most traders don't stop to wonder why that's the case, and if they do, they almost never go deep enough into the topic, which is immense. It's not only a deep and wide subject, but it is also quite interesting because it deals with the rather mysterious nature of the human mind and some weird aspects of it. It is also interesting to find out how the human mind became what it is today and the mechanisms that led to this transformation over thousands of years. In the trading psychology portion of the course, we are going to study two main topics, which are the prospect theory and the relevant cognitive biases that affect traders the most. The prospect theory earned a Nobel Prize in economics, and it was discovered by a psychologist who happens to be a reference in behavioral economics to this day. The prospect theory makes it easier to understand the contradictory nature of how our brain works when we expose it to decisions that involve risk. The heart of the prospect theory shows how we can display aversive or seeking behaviors to the same problem depending on how this problem is framed. This has a major impact for traders because we need to deal with this sort of thing every time a trade is made. The other part of the section about trading psychology deals with the relevant cognitive biases that tend to hinder a trader's performance if he's not aware such thing exists. Cognitive biases are primitive lenses by which we observe the world. They are second nature to us, and many of the activities that we perform on a daily basis and that we take for granted would be impossible without them. Things like learning, memory articulation and decision-making are deeply connected to the cognitive biases. The other attribute of cognitive biases is that all human beings have them without any exception. They precede personality in a way. That's how deeply embedded they are in our biology. As you will find out later in the course, the presence of the cognitive biases in modern society creates something called the intelligence paradox, which is one of those real-life ironies that spiral off of the complexity of our existence. It's quite easy to underestimate the effect of cognitive biases in our trading because they are silent to us in a way. The fact that we have a hard time seeing biases in ourselves is itself a bias called bias blind spot. Once again, that's because cognitive biases are primal intuitions deeply rooted in our biology, and they come from behind us in a way to shape the way we see the world. The study of these two aspects of our psychology help to clear up the fog that surrounds the unique behavior of human beings regarding risk associated with time, which is a major part of trading. In the next lecture, we are going to dig deeper into the prospect theory to understand its amazing conclusions about human psychology. In this lecture, we are going to study a critical aspect of human psychology applied to decision theory in the financial markets, which comes from the understanding of the prospect theory. The prospect theory is so important that it won a Nobel Prize in economics, and it was discovered by a psychologist, which is the man you see in this picture who happens to be a leading authority in behavioral economics. There are two modes of reaction a trader can have when facing a decision in the market, roughly speaking. The trader can seek risk, or he can avoid risk. The hallmark of the prospect theory is that it shows how a person can shift between these two modes regarding the same scenario. The only thing that makes the person shift between risk avoidance or risk seeking is how the decision is framed. In other words, the way in which a person sees a decision is what determines if she is going to seek risk or avoid risk. The interesting thing about this is that the person can shift between risk aversion or risk-seeking behavior just based on how the situation presents itself. That happens because human beings make decisions based on something called heuristics, which are simplistic and automatic decision-making rules that run automatically in the brain. These heuristics are effortless and second nature to us because human beings evolved over thousands of years with the need to make decisions in the quickest way possible, which does not mean these decisions will be made in the best way possible. These are two completely different things. The field of evolutionary psychology claims that our ancestors had to make quick decisions to avoid dangerous situations, and that's how these mechanisms got engraved in our nervous system. As we will see in future lectures, the presence of these heuristics and cognitive biases is a paradoxical practical necessity of our existence, but let's leave that to a moment where we can focus more precisely on why that's the case. For this lecture, it's important to understand the core and axioms of the prospect theory. The heuristics and biases associated with the decision-making process are wrapped by something called bounded rationality, which is composed of three elements. The available amount of information in the moment a decision is made, the time constraint that envelops the decision-making process, and the cognitive limitations of the person making such decision. In trading, all three elements of the bounded rationality are attacked in unfortunate angles. For example, the amount of information a person has to make decisions in the market is indeed limited. That's the problem that high-quality technical analysis attempts to solve, and it is already a big challenge by itself. The time constraint of the decision-making process is also a problem in the markets because traders are always running against the clock, which is a reliable way of augmenting the effect of negative cognitive biases and the overall anxiety level of a trader. The cognitive limitations of a trader are no different than the cognitive limitations of anybody else, but a trader tends to put himself in situations where his counterproductive biases get amplified. This almost always ends badly because our biases are not exactly designed to be rational. They are a byproduct of biological evolution to get us out of primitive versions of trouble. Once again, this refers back to the paradoxical nature of modern social animals like us with primitive cognitive biases. To truly understand what the prospect theory means in practice, we can do a few different exercises to show how we can seek or avoid risk depending on how decision-making questions are framed. Consider the two following alternatives and choose the one you prefer. Number 1. 95% chance of winning $100,000. Number 2. 100% chance of winning $94,499. Let your intuition guide you and pick one of the two alternatives. If you are like most people, you probably chose alternative number 2. However, mathematically, and statistically speaking, the alternative that makes the most sense is alternative number 1. Before showing you what that means, let me explain what this example means under the light of the prospect theory. The fact that we generally feel better choosing alternative number 2 shows us how we tend to avoid risk depending on how the question is framed. Most people pick alternative number 2 because of the fear of disappointment. However, statistically speaking, the correct alternative is alternative number 1 because 95% of 100,000 produces $95,000 over a series of equal decisions while 100% of 94,499 produces $94,499, which is less money. The key here is not to pay attention to what the numbers feel like gauged by our intuitions, but to use mathematics and statistics to discover what the decisions really look like over time. Most people choose the alternative that does not make sense under the light of mathematics and statistics because these things are not part of our intuition. Let's look at a different question to see other types of reactions people might have about this framing problem. Consider the two following alternatives. Number 1. 5% chance of losing $100,000. Number 2. 100% chance of losing $5,100. Once again, this is a question framed to spark risk aversion or risk avoidance. Most people tend to choose alternative number 2 simply because our intuitions guide us to the impression that it is better to leave with a certain small loss than to have the possibility of losing a larger amount. As correct as this might sound, it is mathematically and statistically incorrect. If we analyze these alternatives over a series of equal decisions, we will see that 5% of losing $100,000 makes you lose $5,000 over time, while 100% chance of losing $5,100 guarantees that you will lose $5,100, which is a bigger amount to lose, and therefore an undesirable outcome. After the first exercise, you already know that you should look at these problems using simple mathematics, so you probably picked the correct answer. However, it's amazing to notice how people choose alternative number 2 due to the fear of a large loss. These are the two classic examples of questions framed to provoke risk aversion in most people. Let's now look at two classic examples of questions that provoke risk-seeking behavior. Consider the two following alternatives. Number 1. 5% chance of winning $100,000. Number 2. 100% chance of winning $5,100. From the last two examples, you already know that you should look at this problem under the light of mathematics and statistics, and therefore, you should be able to see that the correct answer is alternative number 2. That's the case because over a series of equal decisions like this, 5% chance of winning $100,000 generates $5,000 while 100% chance of winning $5,100 generates $5,100, which is more money, and therefore, a more desirable outcome. However, as you might be expecting already, most people choose alternative number 1 in the hope of winning a large amount of money. In other words, by listening to their intuitions, most people end up seeking risk unnecessarily. Once again, most people choose the wrong alternative because they are thinking intuitively, not mathematically and statistically. Let's look at a final example that provokes risk-seeking behavior. Consider the two following alternatives. Number 1. 95% chance of losing $100,000. Number 2. 100% chance of losing $94,499. Most people choose alternative number 1 in the attempt to avoid a certain loss. However, we know that alternative number 2 makes us lose less money in a series of equal decisions like this. As you can notice by these 4 examples, the way decision-making questions are framed using different lenses of high or low probability, winning or losing scenarios, and high or low amounts of money deeply affect the way our heuristics lead us to make choices. It's only through the unbiased lenses of mathematics and statistics that we can erase this effect. Another interesting thing that the prospect theory points out is the asymmetrical shape of the utility function. In simpler terms, imagine that we can attribute a psychological value for wins and losses. The asymmetrical shape of a utility function tells us that winning $100 feels 100 points in the imaginary scale of psychological comfort. However, losing $100 feels more than 100 negative points in the same scale. In other words, winning $100 is not symmetrical to the experience of losing $100. There is a lot to be said about the relation between the prospect theory and the idea of using optimal risk-reward ratios over time in trading. Many traders feel uncomfortable with the idea of using a good risk-reward ratio because their win rates are diminished. That happens simply because it's a lot easier for the market to hit a small stop than to hit a large profit target. This is where the concept of trade location comes into play to save the day and balance things out. Let's observe the prospect theory in 2 distinct risk configurations in the market. One is a very irresponsible scalping paradigm in which the trader aims for an extremely high win rate, so his stop-loss orders are large, and his take-profit orders are short. The other risk configuration is a more sophisticated one where the trader maintains the ratios between 1:3 and 1:5. This naturally produces a lower win rate, but it guarantees the trader stays in the game indefinitely, unlike the first configuration that is short-lived. The main difference here is that the first risk configuration fails to recognize the importance of projecting decisions over time, which is the main thing that makes most people answer decision-making questions incorrectly. It feels a lot better to make quick and immediate rewards in the market, but that feeling does not last very long. On the other hand, the second risk configuration takes into consideration the mathematical and statistical side of the decision-making process and bypasses the erroneous intuitive feeling that comes from generating a lower win rate. One of the most important lessons a trader can learn is the maturity to grasp the idea that sacrificing an exceptionally high win rate is a practical necessity to make money in the long term. There is no way around the laws of mathematics and statistics. Now you know how your brain can trick you into making the wrong decisions based on what you feel instead of basing your decision-making device on what is universally accepted as reasonable according to mathematics and statistics. In the next lecture, we are going to explore something called the intelligence paradox. In this lecture, we are going to amplify our understanding of something called the intelligence paradox. This is somewhat a deeper notion about behavioral economics, so first we are going to see the paradox in its condensed form so that later we can unpack all the concepts and ideas that are necessary to its full comprehension. The intelligence paradox can be stated in the following sense. The same cognitive biases that enable the evolution of intelligence in the human brain are the same cognitive biases that hinder that intelligence in modern life situations. The paradoxical nature of this statement lies in the notion that the cognitive biases we have are in great part responsible for our survival over thousands of years of biological evolution, and at the same time, these cognitive biases often catapult us towards irrationality, and therefore away from what we consider intelligence in various examples of our modern social life. Before we can understand this idea more clearly, let's first define the idea of cognitive biases. Metaphorically speaking, a cognitive bias is a lens through which we see the world. This lens steers our thought process, behavior, and decision-making apparatus automatically, so most of the time, we are not aware of such biases. It's common to observe people believe that they are being completely impartial about a given subject, while from the outside, it's perfectly clear that they are biased. We have about 150 cognitive biases, and many of them are critical for the way in which we learn new things and for the way our memory works, which is another way of seeing the intelligence paradox. We need certain biases in order to be able to remember what we learn and recall the new acquired skills when we need to. However, when our biases interfere in our emotions, that's where we can get in trouble, especially when we're dealing with the financial markets. The great question here is why we possess these apparently counterproductive biases in the first place if they seem to cause more trouble than anything else. The problem is that the time span of the existence of modern society compared to the time span of the biological evolution of our brains is tiny. That means that for most of the time, our brains have been naturally selected to deal with primitive problems like avoiding dangerous animals in the wild, tribal fights and things like that. Only very recently we have been forced to learn how to deal with modern life situations like trading, in which we deal with the faults of our own existence in a way. Our biases are very good for primal activities without which would be impossible to learn and develop memory. However, these same biases get in our way when we need to make decisions in an economic paradigm. As we saw in the last lecture about the prospect theory, the decision-making process of traders in the markets attacks the bounded rationality idea in unfortunate ways in all three angles. We have limited information to make decisions in the market, so right from the start, a whole branch of cognitive biases that deal with how we recall memory must be triggered in order for us to indeed make decisions. The second element of the bounded rationality, which is time constraint, also triggers a series of cognitive biases that deal with the notion that we must act fast in our decisions. Evolutionary psychology tells us that we develop this urge to make fast decisions due to the survival paradigm in which our ancestors lived. For example, if you were a human thousands of years ago, and you had to decide about the danger of facing an unknown animal, for example, the humans that made quick decisions were naturally selected over the humans that were not quick enough to make such decisions. Remember that fast decisions are not necessarily good decisions. Quick decisions are made for survival, but trading requires well-thought-out decisions. This is why every trader needs a trade plan, which is a way to make fast decisions based on well-thought-out ideas. This is so important that we define the trade plan as one of the dimensions of a professional trading strategy. The third element of the bounded rationality, which is the cognitive limitation of the decision maker, just sums up what we have been talking about in this lecture. Cognitive limitations can be understood as a combination of how amplified the biases can get with the addition of IQ, which is the cognitive ability to articulate and understand abstract concepts. It's important to notice that we all have the same cognitive biases as we are part of the same species, but our personalities vary greatly, and that serves as a catalyst to amplify certain biases and diminish others. If we bring these concepts to a more practical approach of the markets, we are going to notice that we do irrational things automatically, and that's an incredibly dangerous idea. Since cognitive biases are so deeply embedded in our minds, we don't notice when we are being biased, especially if we don't know there is such a thing called cognitive bias, which is the case of most traders that enter in the market. Just like the subtle points of view detected by the prospect theory, the biases control how our thoughts arise in consciousness and how these thoughts will be steered in a way. In this course, we will study most of the relevant cognitive biases that affect traders the most. By doing that, you will gain an edge over the traders who do not possess this knowledge. Another advantage of studying trading psychology more deeply is that we can take precautions that will enable us to avoid certain psychological pitfalls that are guaranteed to happen in trading. However, before we proceed to study the relevant biases one by one, let's solidify the notion of the intelligence paradox to finish this lecture. We already have a good idea of what cognitive biases are, where they came from, and why they are still sticking around with us to this day and will probably do for a long time. The intelligence paradox states that the Homo sapiens would not have developed high intelligence if these cognitive biases were not present to allow our species to survive long eons of time. At the same time, these biases tend to get in our way in modern life situations that are part of our complex social networks and hinder the intelligence they allowed to develop in the first place. That's the paradox. Intelligence could not have been developed without these primitive lenses to guide our ancestors to overcome their simple problems, but since our species did that sort of thing for a very long time, these biases were deeply engraved in our psychology, and now we must know how to deal with them in a different paradigm, which is the modern world. The problem is that these biases were built and naturally selected by the primitive world. It's almost if we had a primitive sleeping ape inside our minds at all times, and the wrong stimulus from the external world is enough to wake up this creature. The problem is that this creature has no idea how to manage its emotions, and it acts completely by instinct and is driven merely by survival. That's the underlying psychological structure that goes on when you see a trader punching his computer screen out of anger towards the market. You can probably imagine that letting this metaphorical sleeping ape trade for you is a really bad idea. In the next lecture, we will begin the fascinating study of the cognitive biases and how deep these psychological traps can get. Availability heuristic is a cognitive bias in which a decision maker relies upon knowledge that is readily available rather than examine other possible alternatives to a given situation. It is easier for us to recall information which has recently arrived. The main application of the availability heuristics in trading lives in the difference between building a solid context for a trade and trading by impulse. Building the correct context for a trade situation involves a significant degree of patience and mental effort, but it is the only way we can access the necessary depth of analysis. Unfortunately, the availability heuristics is the natural state of our minds. We tend to use the information that is more easily available simply because it's easier, and we tend to avoid producing cognitive discomfort that comes from deliberating about the details of a situation. A trader who trades with the availability heuristic in an amplified state is not worried about the context of the market or what's happening in the battle between buyers and sellers. This trader only wants a simple trigger to enter and exit the market automatically. Hopefully that does not sound too familiar to you, otherwise you might have to train yourself to dial down your availability heuristic. The way to do that is to first recognize the existence of such bias, and the second is to accept that contextual trading is the correct way to approach the markets. The attentional bias is a cognitive dissonance that makes people be more influenced by their recurrent thoughts. Like the availability heuristics, the attentional bias can easily put traders off track by making them focus on the wrong things. For example, the recurrent thoughts of a trader might make him forget the context of a market for a brief moment. A classic example of this is the trader who watches the news while trading. As far as we can tell, watching the news is only a source of distraction that blurs the correct analysis of the market that it is usually accomplished silently and without external noise. Watching the news might give you the sensation that you are connected to the market. However, this is an illusion, and the sad reality is that, most of the time, watching the news is counterproductive due to the attentional bias. This cognitive bias reflects the tendency people have to start believing information that has been repeatedly exposed to them. In other words, if you hear or see the same information too many times, you have a natural tendency to start believing it, even if you are aware that such information is just an illusion. That becomes a problem in the financial markets when traders are continuously exposed to bad information on how to trade and on how to manage their emotions. The illusory truth effect is quite powerful in the financial markets because there is a lot of people spreading out misleading information about how traders should act. Due to the way our brains are wired, if we don't have a good theory about something, we will end up trusting a bad theory, which to us feels better than no theory at all. There are many ways to trade the market that seem reliable and trustworthy, but many of them are shallow and only look good on the outside. The illusory truth effect plays a big role in letting the wave of misleading information continue to grow. By becoming a little more aware of the illusory truth effect, we can begin to select the information that we use in our trading in a more efficient way. After all, defining high-quality context for your trading ideas is all about weighting information rationally. This is the tendency people have to attribute more meaning to information that is familiar to them. Once again, this spirals from the intersection between our pattern-seeking nature and our inherent need for survival. Trusting familiar information is also a key component in the learning process. In the financial markets, traders tend to display the mere exposure effect in a larger scale because most of the information about how price works is blurry, so it's easy to attach oneself to an idea that makes sense apparently. In other words, in the financial market world, which is chaotic and confusing to most people, a piece of information that makes sense is an unusually attractive beacon of comfort. Here you can see that the very nature of how mysterious the financial markets can be is already enough to mess with our cognitive biases in a counterproductive way. We must develop some kind of filter if we want to have a reliable approach to the markets. Comforting pieces of information like the idea that one can trade without risk, for example, are very attractive, but they are completely misleading, and only serve as a distraction. This is a familiar bias to most people who have some experience in the markets. The mood congruent bias is when your mood affects the types of memories that are triggered in your mind. If you are a trader with a lot of bad experiences in the market, this can be a problem. If you happen to be this type of trader, even a certain type of market scenario can trigger really bad emotions if you are in a bad mood already. Needless to say, it's always better to trade in a relatively neutral state of mind. Too optimistic is not good because it can make you go after opportunities with no real context behind them based on a feeling of shallow hope and pure optimism. Excessive optimism has its place in certain aspects of life, but the financial markets are not one of them. Trading in a negative state of mind is also bad because it can drive you to a downward spiral and a negative cascading effect that usually ends badly. This is also known as the frequency illusion, and it refers to the effect of learning something and subsequently seeing this new thing everywhere. This is also common in the financial markets. It can be a problem when one type of market analysis blurs other necessary ways of seeing the market. This is very common among traders who can only trade using technical indicators. For example, a trader like this can only see the market through the light of one specific indicator, and he cannot begin to understand the market in a multi-layered fashion like we've been trying to do over this course. This is usually a reflex of having poor information about the market. One of the goals of this course is to make the Baader-Meinhof phenomenon a little looser by showing you how a market should be analyzed from different angles and different types of analysis. The empathy gap is a cognitive bias that reflects how people can neglect the impact of primitive impulses in their behavior and choices. For example, when a person is angry, it is almost impossible for this person to understand what it feels like to be in the opposite state. This works in a personal level as well as in an interpersonal level. For example, it can be hard for people to put themselves in the shoes of other people. The result is the underestimation of other people's feelings and an overestimation of our own feelings. We tend to overestimate our own feelings over the feelings of others simply because our own conscious experience is simply more interesting to us. We don't really feel another person's suffering. We can only feel empathy for it, hence the name of the cognitive bias. For the world of trading, since the interaction happens between a person and the price chart, the empathy gap occurs in the personal layer, meaning that the trader will underestimate how the primitive impulses we potentially display under extreme circumstances will influence our behavior and choices to a significantly important degree. One very good example of this is when a trader, who is usually not making use of any risk management methodology, finds himself in a losing streak that deeply affects the overall equity. Let's imagine that this trader was overloading positions, and because the trader was caught in a losing streak, the damage produced on the equity was significant enough to make this trader angry about the loss. Just the sight of the lost capital on the trading terminal is enough to keep the anger momentum going. This circular behavior eventually erupts in a fight-or-flight instinct resulting in violence like punching the computer screen or simply being in shock by the overwhelming reality of the recent events. There's no one to blame here other than the trader, of course. Some traders even try to blame the market in a ridiculous attempt of removing the guilt out of one's shoulders. It's unfortunate to think that what led this trader to this type of behavior is twofold. First, the ignorance about what can happen when traders don't use good money management. Second, the empathy gap on a personal level that made the trader misunderstand that when anger was emerging in consciousness, the correct thing to do would be to simply stop everything and reevaluate. Notice this is extremely hard to accomplish depending on how angry the trader is at the moment. That's why it is necessary that this process is ceased before it reaches a point of no return, so to speak. Some traders don't even know they can experience such emotions in trading. Once again, the first step for preventing this kind of situation is being aware that it can happen and how it happens exactly. There are a few traders that have experienced this many times, and they will continue to do so because they know nothing about the mechanisms that are at play here. It's possible that some of these traders even think there is some sort of psychological problem with them, but that's clearly not the case. It's not wise to exclude that possibility for all cases, but most of the time, the traders don't suffer from any sort of psychological illness. This is just what happens when primitive behaviors are fully triggered. If you think that studying trading psychology is boring, this last example might serve as a source of motivation to get through the boredom. In other words, taking a trading situation to such extreme is trying to apply the primitive wisdom of our ancestors to a modern-day paradigm. It's easy to see that this is absolutely going to fail 10 times out of 10. There is the need for the trader to develop a certain impartial attitude towards one's own emotions. This is a difficult process, and most people don't involve themselves with it because it requires a constant calibration of one's behavior towards everything else. Again, it's never enough to stress the importance of being theoretically aware of such possibilities. The trader who already had these experiences has the practical advantage of evaluating them in a personal way and in an isolated manner, but this doesn't mean it's necessary to have such experiences to really understand that they are bad and that they should be avoided. The best-case scenario to prevent biases like the empathy gap and others as well is to never be subjected to the full practical potential of these biases, but only to be theoretically aware of them. There is no reason we should think that a person should be subjected to bad experiences in order to really understand what they mean. We must be intelligent enough to learn from the mistakes of others. If we relied on the paradigm that we should experience everything ourselves, it could take more than one lifetime to understand all these things we must necessarily understand to become consistently profitable traders. The omission bias can be categorized as the impression that harmful actions are worse than harmful inactions even when the outcome is the same. This can be easily transported to a trading scenario in the following sense. To generate consistent profits over time, the trader needs to take actions regarding a particular financial instrument. Depending on what type of personality the trader has, actions may be more natural than inactions and vice versa. Imagine that a trader that has more of an impulsive personality trying to trade a particular market with an exaggerated level of aggressiveness. Let's also imagine that the result of this endeavor is that the trader breaks even. In other words, the trader didn't change its capital because the sum of profits and losses during the period was equal to zero. Now imagine that a trader with a passive personality is being too passive about the market to the point that he barely trades at all. The outcome, of course, is break even. The outcome of both personalities is the same in this case. How can we really say which one is worse? We can't arrive at this conclusion objectively because we need to look at them from the angle of the outcomes. Sometimes it's better to be passive about the market, and sometimes it's better to be active about the market. The ideal scenario to be in trading is similar to sniper mentality that patiently waits but doesn't hesitate when the right moment arrives. Throwing shots at every single noise you hear would be amazingly wasteful and dangerous at the pace that never shooting at all wouldn't get the job done. Certain actions that appear to be good in the short term can have a disastrous effect in the long term. At the same pace, actions that feel counterintuitive in the short term can have a good effect in the long term. The essential point of this is looking at the outcomes considering the statistical significance of such actions like we studied in the risk management portion of the course and in the prospect theory lecture. This cognitive bias is also known as the isolation effect. When people are subjected to various forms of similar stimuli, or similar types of information, they tend to give more importance to the string of information that stands out the most. This is an obvious reflection of our pattern-seeking nature. This behavioral paradigm is so deeply ingrained in us that we do this automatically all the time. The von Restorff effect is one of the tools used by market makers to confuse retail traders in a subtle sleight of hand. There are many times in the market that large traders intentionally produce abrupt market movements to trigger the impulsive behavior of less advised traders and also to bring the attention to a certain part of the market while the most important parts of the market go unnoticed. This is one of the most cynical secrets about how large traders can literally manipulate the retail traders by using reverse psychology and a type of psychological flaw that is inherent in all human beings, including market makers of course. The difference here is that market makers are fully aware of how such bias displays itself, and they are very proficient at triggering this sort of behavior in other traders. The focusing effect, as the name suggests, is when a person places an exaggerated amount of importance in one event inside a larger context. In the markets, the focusing effect can happen on a regular basis in various situations. The area where this tends to happen more often is when traders analyze their performance. The focusing effect can happen, and it's probably more toxic when the trade series under analysis is not large enough to produce statistical significance. For example, imagine that a trader makes 10 trades and uses these 10 trades to evaluate performance. Contained in all these trades are a series of losses and one disproportionately overloaded trade that made possible for the overall equity curve to have a positive result. The focusing effect would happen when the trader in question rationalizes his positive outcome just by the fact that it exists without considering how the trader got to that result in the first place. The way to do that is by just focusing on the large trade that probably had a great deal of luck involved in it. Traders under this paradigm tend to say things like, "I know I'm doing something right because I made profits quickly, and that wouldn't happen if I was wrong about my strategies." A statement like this is clearly mistaken if you take into consideration everything that is being said here. Namely, the trader is completely excluding the role of luck in the one trade that made the equity curve profitable. The trader is not considering the factors that led to his losses. The trader didn't use sound risk management to frame the trades. The trader is ignoring the statistical significance of the trading sample. The trader clearly wants to be proven right instead of being skeptical about the results. To achieve the status of being right in this context, the trader needs to reverse the approach. If we attack this trading sample from all angles and it survives, the trader is very likely to be right about the performance being good, otherwise he might be just misleading himself. The framing effect is the natural inclination people have to react differently to information depending on how it is presented. This phenomenon goes hand in hand with the prospect theory, where you have a mathematical explanation of how people tend to avoid or seek risk depending on how the question is framed. The problem is that mathematics and statistics are not intuitive to us. We need to force ourselves to think in these scientific terms. The prospect theory exemplifies this phenomenon in the simplest way possible. The key to understanding the true meaning of numbers and probabilities within behavioral economics is to extrapolate how a particular decision would affect your perception of the problem if this decision was made multiple times. This is, in more complicated terms, the concept of statistical significance. Just look at the expression statistical significance. The word significance is there to show that one simple isolated action carries no explanatory quality about its extrapolated value throughout time. This is the only way to understand these problems in their real sense. This cognitive bias shows the discrepancy between an individual's perceived change of something and the actual change of something. In basic terms, this law states that the relationship between stimulus and perception is logarithmic. In other words, if stimulus varies geometrically, perception varies arithmetically. This idea can be practically observed when a trader risks exponentially larger amounts of capital. The logarithmic relationship of stimulus and perception explains why a trader in that situation keeps doing what he is doing until he is forced to stop. In this case, the Weber-Fechner law explains the trader's reckless behavior. The logarithmic relationship says that if stimulus varies geometrically, which means that it will be multiplied by a fixed factor, the perception will vary arithmetically, which is to say in an additive manner. In practical terms, it would look something like this. Imagine a trader begins risking 1% of the capital, and this trader multiplies this percentage by a factor of 2 in each trade that is made. The series of trades would look like this: 1%, 2%, 4%, 8%, 16%, 32% and 64%. This represents the stimulus. However, the perception of the trader still functions in an additive manner respecting the original value, which was 1%. To the trader, it would feel like risking 1%, 2%, 3%, 4%, 5% and 6%. I said this explains the trader's reckless behavior, because to his point of view, no real significant change is being made in the risk. The reality of the situation is completely different, as you can see. This is one of those unfortunate realities about our minds that seem to have had advantages to our ancestors, but not so much in modern days. If you think about fights, for example, the Weber-Fechner law is very useful to the person who is losing, therefore it is a form of survival or defense mechanism. This might have been selected as a cognitive bias that helped our ancestors to survive uncomfortable stimuli. Individuals who had this bias obviously would have a better chance to survive than individuals who didn't have it. It's a natural way of numbing unnecessarily big perceived stimulus as a defense mechanism. This bias shows the inclination we have to search, interpret, favor, and recall information that confirms our pre-existing beliefs. This is a big one in the financial markets, and it's one of the main reasons that hold traders back in their road to success. The confirmation bias can be observed in the markets when a trader confirms his beliefs in a technique when it works and ignores this same technique when it doesn't work. This is obviously very counterproductive because in reality we must deal with both positive and negative sides of everything that we do. There is simply no escape from that. However, the confirmation bias poses a great opportunity depending on how we decide to approach it. For example, if we always try to see the advantages and disadvantages of a market theory or technique, we will be able to learn a lot about it, and also learn a lot about the market as well. This is actually one of the cornerstones of good contextual trading. When we look at the charts, we automatically form a bias about its future direction. This process is immediate, and we cannot really stop it. However, we can force ourselves to see conflicting possibilities of a market and observe which one of them plays out, and the reasons one context ends up winning over the other. The big lesson here is to be aware of the confirmation bias, and deliberately try to counteract it by embracing the negative sides of any given technique in an attempt to extract some good out of these negative sides by conflicting them with the positive sides of the technique. That's a surprisingly liberating thing to do. This bias refers specifically to the initial reflex people have when faced with new evidence that collides with pre-existing beliefs. What's interesting to notice about the Semmelweis reflex is that it is immediate and involuntary. In other words, when people are presented with new and compelling evidence that aims to destroy one's pre-existing beliefs about something, the immediate response is denial. The fact that it is immediate says a lot about the believing software of our brains. It's easy to recognize that this immediacy is counterproductive to several degrees, and yet, in real time we will tend to operate in this way indefinitely even after this recognition. The whole idea about denial is quite interesting. We see our minds and the beliefs it subscribes to as a fortress. The first reaction the guardians of the fortress have to external strange attackers is to counterattack instinctively. However, if the attackers use a different methodology, they might enter the fortress to convince everybody inside that they have been mistaken about their approaches. In other words, the way to effectively attack any held belief is through reason, not violence. I mean violence here metaphorically speaking, of course. Let me give you an example. If somebody says something like, "You're wrong for believing such a thing," your Semmelweis reflex will trigger immediately. You will feel it even though you might not show others that you felt it. However, if somebody approaches you and say, "Look, I think you should reconsider your belief in X because of this and that," the effect such approach has on your Semmelweis reflex is a lot weaker. In trading, there will be no one telling you that you're being stupid about anything. It's you against the market, and we already pointed out that the market is incapable of caring about your feelings, so you will be left with your thoughts to reflect about your actions. Speaking in practical terms, you will be against yourself when you are trading, and that's surprisingly difficult contrary to what most people believe. There are ways of triggering the Semmelweis reflex by yourself. Just imagine a trader who is getting consistently losing trades in the market. He's facing an extraordinary amount of evidence that suggests he doesn't have any good idea of what he's doing. Usually the response is self-denial, and here lies the big problem. As it is widely known, the easiest person to fool is yourself, so you will be capable of remarkably interesting feats of creativity to convince yourself you are not as bad as the results you are generating. Meanwhile, deep down you know that you might be too biased about yourself. The lesson here is to embrace your flaws as soon as possible and work your way up from wherever you are. It doesn't matter how bad it is. It's certainly better than keeping yourself in the vicious circle of self-denial. The bias blind spot is the ability an individual possesses to successfully identify biases in other people's behavior while failing to recognize his own biases. We can't erase these biases. What's important is to admit that you're going to be biased in one way or another. Ironically, this is the first step in going around such patterns of thinking. It's not really a matter of not being biased. It's a matter of discovering how you're being biased, which biases are taking place, and reducing the effect of such thinking patterns to a realistic degree. Just the simple sight of the illustration of the cognitive bias list is enough for us to realize that erasing all cognitive biases at once is far from being a possibility. The recognition of the bias blind spot is a great lesson in humility, and it serves to teach us how to evaluate ourselves a little better before judging other people's actions. It's part of the process of developing a healthy level of self-awareness. Clustering illusion is the tendency to mistakenly consider small clusters of information as relevant, like small winning or losing streaks for example, that will inevitably arise in data with low statistical significance. For example, if you randomly generate a small sample of trades, you will notice that small clusters of winning and losing trades appear. This can give you an illusion that this randomly generated strategy has some sort of quality. However, this is how data inevitably behaves. Let's take the example of a randomly generated series of trades where the risk-reward ratio is 1. Theoretically speaking, if you generate enough data to have statistical significance, the ratio between winning and losing trades is going to be 50%. However, if you generate a small amount of data, it can give you the impression that this randomly generated strategy has some sort of tendency. The first 10 trades of this sample could be winning trades, for example. If you only analyze this small cluster of the data, you have the impression that the system tends to win more than it loses, which we know to be incorrect in this case. The clustering illusion, along with other similar biases, is the number one enemy of successful risk management application in the markets. Since we also observed that trading without good risk management is a bad idea, we can understand how something very specific can have such broad consequences. If you're not able to go around your clustering illusion, you will fail as a trader. There is no other option in this case. I would say once again that this bias comes from our pattern-seeking nature. We desperately want to find patterns to understand the world around us, and we do this automatically. In fact, we must do it to a certain extent, otherwise we would need to relearn the same things every day. If we didn't have the capacity to form patterns, we would need to get a new driving license every time we stepped inside a car. In fact, just to get to the car in the first place, we would need to learn how to walk every time it was needed. The essential point is, pattern seeking is essential to learning, which is essential to life in general. However, obsessive pattern seeking can turn into things like the clustering effect. Naive realism is the idea that our senses are capable of always giving us access to the true reality of things. In other words, it's the idea that we can always trust our senses immediately without considering the possibility that we might be subjected by illusions of various types. This applies to the physical world and, more prominently, in the realm of ideas. It's a lot easier to be mistaken about ideas than to the appearance of a physical object, for example. Some people tend to trust their senses and their thinking too much to the point it begins to sound like arrogance. The fact that arrogance sounds bad to us goes back to the original idea of naive realism. If a person is being too confident about something, she gives the feeling that she is being negligent and that she doesn't care to be negligent about the fact that she might be wrong about stuff. It's comforting to see that most people react repulsively in the face of arrogance. This is a sign that arrogance has indeed bad effects in the long term, and we should avoid it to the best of our efforts. Naive realism can happen in trading as well. In fact, it is annoyingly common in any financial market. I've seen many traders move on from being intelligently skeptical about their abilities to being stubborn and unrealistically arrogant about them. Even if you are a very good trader, if you cover your set of skills with the wool of arrogance, your skills will wither eventually. This sort of thing can happen when traders are overwhelmed with the fact that they can make a lot of money in the market. The sad and ironic reality is that this initial arrogance covers the trader's eyes and catapults him back to the starting point, and he needs to earn his skills and equity back. In a way, the only set of tools we possess to really get in touch with reality is our senses and our reason. The subtler mistake is to trust anything immediately without engaging in any sort of investigation about our sensory and cognitive experience. It's amazing to see that we have such mechanisms, and it's incredibly liberating to see that we can choose to behave in certain ways. The bottom line is that we should be aware of the possibility of being naive about reality, and therefore, we should always be a little skeptical of ourselves to maintain this problem in check. The gambler's fallacy is one of the most common cognitive biases in the financial markets. The bias occurs when a trader believes that because losing trades happened more frequently than normal in a given period, winning trades will occur more frequently than normal in the future, in a sort of expectation that nature balances itself out eventually. This is demonstrably false. There is no compelling evidence that shows trades will balance themselves out in that way, because the probability attached to each trade is independent from every other trade, which is the same thing as saying that trades are not causally chained to one another. What happens is that actions only show their true nature when they happen many times in a row, and anything that can happen will happen if you wait long enough. Let's make an exaggerated example to illustrate this situation in a better way. Let's assume a trader has the firm belief that if he wins 7 trades in a row, he'll be absolutely convinced of his ability and therefore won't need any help from technical analysis tools or any other methodology. The trader with such belief probably doesn't know that even random trading strategies can produce way more than 7 winning trades in a row. The trader also probably doesn't know that anything that can happen will happen eventually, so at some point he will make 7 winning trades in a row. It doesn't mean he will prove his ability. Another toxic example of this is the application of martingale strategies that double the risk every time you lose, so eventually one win compensates all losses. The problem with such mentality is that virtually infinite capital is needed for this to work, and that's precisely what traders don't have. There is no rule that says the odds of making a winning trade increases as the current losing streak increases in size. That's the heart of the gambler's fallacy. Once again, there is no causal link between the probability of various trades. The probability of making a winning trade does not increase as you produce more losing trades. The hot hand fallacy, similarly to the gambler's fallacy, is when a person feels that she has a greater probability of future success based on the present success of a random action. For example, if a trader is randomly buying and selling in the market, and out of sheer luck, he produces a winning streak, this trader has the tendency to be subjected to the hot hand fallacy. In other words, he will have the feeling that his future actions will be as easy as the present outcomes. Notice that people who tend to fall in this psychological trap are completely ignoring the role of luck in decision-making. It is imperative to point out that luck always has some degree of influence in our decisions. It's cliché to say that good luck happens when preparation meets opportunity, but that's not completely true in my view. Good luck is simply good luck. The intersection between preparation and opportunity is consistency. Good or bad luck are only inevitable variables that we cannot control, so it's not wise to count on them. The bandwagon effect is when beliefs are amplified because they are already held by a group of people. You might have already noticed that people behave differently when they are in groups. It's not difficult to extrapolate this paradigm back thousands of years ago, when this sort of bias was much more useful for our ancestors' survival ability. They probably had to develop some sort of bandwagon effect to fight against dangerous animals, other tribes, and things like that. Let's not be so extreme and say that the bandwagon effect is useless in modern society, but today it has a few diminishing returns. The main problem with this bias is that it tends to make people behave in a more primitive way, where the main goal is not rational thinking. It's mainly the integrity of the group itself. It's weird to observe that, in any given group, individuals who increase introspection or try to question in-group members about the group's rules, tend to be ignored or left behind. This is not a bad place to be in, sometimes depending on where the group is headed. This sort of phenomenon can happen in many ways in the market. The most extreme example is when a trader sees price action get unusually agitated and then, out of mere impulse, he jumps on whatever bandwagon he can see, metaphorically speaking. The group he will subscribe to depends on what he knows already, of course, so if this trader likes to trade based on a raw intuition of what the market is doing tick by tick, for example, that's where his impulse will come from. Believe it or not, many people trade like that in the market, which is a gamble, and needless to say at this point, completely mistaken. The moment-to-moment intuition of what the market is doing derived from the most current tick pulses is a dangerous starting point for your actions as a trader. To illustrate with a less extreme example, let's observe the trader who likes to trade based on simple notions of support and resistance. This trader will observe the obvious levels of support and resistance on the chart, and he will prepare himself to act when price gets to those points. If he has no plan of what to do when price does reach these levels, he can simply jump on the bandwagon of the first primal intuition of what the market will do next, which is the same as trading by impulse. All these examples have one thing in common. When traders feel they are missing the bus in the market, they will tend to make any effort, no matter how unrealistically deceptive they might be, just to get in a trade to see what happens. At this point in the course, you can probably imagine how much the market makers love biases like the bandwagon effect. These large traders expect that the vast majority of traders will act by impulse, and that is one of the ways in which the market makers capitalize on retail traders. The zero-sum bias is the tendency to think that when someone wins, another person has to lose in any given system. That is true if you look at the market in the objective light only. However, if we look in the light of the overall value of money contained in a market, the zero-sum classification is wrong. The objective transactions between traders in the market is indeed a zero-sum game if you look at money in the nominal way, meaning if you look at money in objective terms. When you consider all the variables contained in a market, which includes people's subjective interpretation of price, which is called sentiment, you cannot classify the market as a zero-sum game. In reality, the market has the objective layer, and the subjective layer. This second layer makes it impossible to classify the market as a zero-sum game. That happens because the relationship between nominal value and market sentiment varies. In other words, the perceived value of nominal price fluctuates, so we cannot classify the market as a zero-sum game. Oddly enough, our first intuition about the financial market seems to tell us that the market is a zero-sum game, which is just another example of how we can be confused about our surrounding reality. The hindsight bias is the tendency we have to see events as predictable only after they happened. The hindsight bias poses a great challenge. At the same time it poses a great opportunity to learn how the markets work. For example, if we make a biased analysis of past market history, we tend to learn nothing about how the market works. However, if we develop the ability to perform unbiased analysis in hindsight, we can learn precisely how markets behave. The key here is being absolutely unbiased about what the market did in the past, which is not so easy. We must confront all possibilities of a market even when we know what the outcome is. That's the only way of extracting value of the hindsight bias. The outcome bias is when we make judgments about the quality of a decision when we already know the outcome of such decision. This is a blessing and a curse, so to speak. This bias has tremendous values, at the same time it can be misleading. This is similar to the hindsight bias, and it happens to all traders. When a trader opens a historical chart, he immediately starts to find specific points where his current strategy would have worked. The trader usually tends to ignore the places where the strategy would fail. The fact that traders can see in hindsight what happened with price creates this illusion that trading strategies would have worked a lot better than they actually do in real time. This dynamic of focusing on the parts where a strategy works and ignoring the parts where a strategy does not work is clearly misleading. As we saw in the video about the hindsight bias, we can extract some value of hindsight analysis if we analyze all possibilities of our strategies in the past, which is to not ignore the faults of the strategy. The restraint bias happens when people overestimate their ability to control impulsive behavior. This is one of the most important biases traders must deal with in the financial markets for reasons that should be clear to you at this point of the course. Impulses, by definition, are involuntary actions that come out of our primitive nature, which is still annoyingly present in inconvenient moments of modern life. One could argue that impulsive behavior runs in the opposite lane of what would be considered rational and intelligent behavior nowadays, meaning that smart outcomes usually spiral from well-thought-out and planned actions. However, this ability of making rational decisions is only possible in human beings after millions of years of evolution. In other words, the impulses and biases that enabled our intelligence to appear in the first place are the same impulses and biases that destroy this intelligence in modern-day paradigms. This is the paradox of our intelligence. The overconfidence effect is the illusion people have that their subjective interpretation of their own abilities is positively greater than the objective measurement of such abilities. You see this in traders all the time, usually in the ones who experience some level of success in the short term. Traders who experience success in the long term don't show overconfidence because, to be profitable in the long term, they need to develop ways of suppressing overconfident behavior, otherwise they will shoot themselves in the foot eventually. Overconfidence is such a misleading emotion because it feels great, but it slowly and silently destroys a trader's ethic. This is another cynical detail about our minds. We can feel well at the same time that we are acting in very counterproductive ways. Overconfidence is an exaggeration of confidence, of course, and it serves to demonstrate that our emotions should be carefully balanced inside a spectrum. Confidence is a good thing, but too much confidence will blind you and ironically make you underconfident over time. The key point is to always try to maintain yourself relatively confident without being whipsawed to either side of the spectrum. The Dunning-Kruger effect is the tendency people with low level of information have to overestimate their abilities and people with high levels of information have to underestimate their abilities. This bias is applied all over any financial market. There are tons of people with nearly zero education about how the market really works, and these same people feel like professional traders of the highest caliber. Meanwhile, we have a few people who understand a lot about how the market really works, and you will constantly see them providing caveats and hedges about their views of the market. The Dunning-Kruger effect happens for a very simple reason. People with more information about the market are aware of how much trading can go wrong if you don't know what you're doing. On the other hand, if you actually don't have a clue of what you're doing in the market, it's a lot easier to convince yourself that your trading skills are solid precisely for the fact that you don't have the necessary knowledge to test or measure them correctly. Beyond that, we already saw in many examples how traders can get results that look good on the outside but are doomed to fail over time. The Dunning-Kruger effect is yet another cynical and ironic face of the reality of our minds because it shows how knowledge can have a bad side attached to it. However, we must find ways of bypassing the disadvantages of having too much information about the market because there are only two possibilities here. We either know almost nothing about the market, which is obviously going to lead us nowhere, or we can know a lot about the market and try to calibrate how this information can prevent us from trading. The only reliable option is the second one without any doubt. The Peltzman effect is the other name of the risk compensation bias. The famous example of this is that drivers who use seatbelts tend to drive less safely and end up increasing their chances of getting involved in a car accident. In other words, the driver feels justified to drive less safely because he is mitigating some of the risk involved in driving by using a seatbelt. Ironically, this risk compensation software our brains possess tends to increase risk in overall terms. Just look at the driver example. He's simply increasing his risk of getting involved in an accident by driving less safely. There is a parallel between this car accident example and the use of stop-loss orders in the financial markets. For example, some traders feel that just by using a stop-loss order they are completely immune from any risks in the market. That's not true because you still need to know where and why to put stop-loss orders. You can't simply arbitrarily choose stop-loss levels and expect good results from it. The parallel is that traders will tend to justify a bad trade idea just with the fact that it has a stop-loss order attached to it. Notice that the Peltzman effect is quite subtle, and it can make you feel like you're reducing risk in the markets. In reality, the overall long-term risk is just being increased. Hyperbolic discounting is the tendency for people to choose a smaller and sooner reward over a larger and later reward. This is one of the major cornerstones in behavioral economics, and it has huge impacts on how traders act in the markets. Because of the risky nature of any financial market, traders will desperately try to avoid exposing themselves for too long. The immediate effect is to favor trade ideas that give short and quick rewards rather than trade ideas that keep you worried for too long about the outcome. This apparently makes perfect sense to us on an intuitive level, but it makes zero sense mathematically and statistically speaking. We already know that short and quick trades tend to have an unstable quality where the stop-loss order is either too close to the entry point or it has no logical ground for existing, or a mixture of both situations. Also, there is the important idea about risk-reward ratios, which is often distorted in these kinds of trades. Counterintuitively, the temporary success one can get from trades operating under these circumstances give the clear impression that the trader is slowly but surely building his equity with great consistency. This is exactly the opposite of what's happening. Unfortunately, our minds have this reverse way of reasoning when we deal with economic decisions, and that's one of the reasons why trading can be so mentally demanding. Apart from the challenges found in technical terms, this violently twisted perception we have about our decisions is a major deal breaker in how we see the trading activity as a whole. Hyperbolic discounting is a major bias, but it is easy to counteract it when you understand it well enough. It doesn't involve strong impulses that are hard to control in real time like a few other biases have. For example, in most cases it is easy to stop yourself from falling under the wrong scalping paradigm if you know how unworthy that road can be. The sunk cost fallacy refers to the error in judgment while analyzing the possibility of future costs based on past costs. The trading translation of this situation is when a trader ponders about the future outcome of his trades based on the previous ones. If the previous trades have been unsuccessful, the trader can see them as a cost that cannot be recuperated, and therefore, the state of mind in analyzing future outcomes would be affected. This is very common in the market, and it is similar to the gambler's fallacy in a way. The negative psychological effect that emerges when a trader is inside a losing streak should not exist in theory. However, we know things work a little differently in a real trading situation. There are subtle variables at play here, like the size of the losing streak, how much money was lost, and how the trader processes all of this information. It may be possible that viewing past trades that went wrong as costs is like giving a wrong connotation to these events. Once bad trades are settled, the trader must simply move on and forget about what he can't change. This is, of course, a lot easier in theory than it is in practice. I say this is a wrong connotation because this idea of cost can put you in a cascading mindset if you're not able to escape a losing streak. For example, as a losing streak grows in size, you will keep reminding yourself of how much money you already lost and how many trades in a row you lost. With each one of these trades, the psychological effect of losing will be greater and greater. The essential point is to discard the idea that lost trades are a cost. The ideal way of viewing such trades is that they are normal trades that ran their course, and losses not only can, but will be part of any trader's routine. The irrational escalation is the tendency people have for repeating a type of decision that has been producing bad outcomes instead of deviating from such type of decision to correct the course. This idea reflects the slippery slope quality of our minds in the intermediary terms of a losing streak. This cascading effect I referenced a few times over the course is precisely the irrational escalation effect. This is a cognitive bias because, mathematically speaking, there should not be any cascading effect at all. For example, let's say that a trader risks $1 per trade, and we can measure how bad he feels when a trade is indeed lost with the same units, so when he loses $1, he will feel a negative effect equivalent to -1. Here is where the irrational escalation really occurs. If the trader loses another trade, his emotional state won't be equivalent to -2. It will be a little worse than that. Something along the lines of -2.5 perhaps. This effect keeps increasing with each sequential losing trade until a winning trade appears or a margin call happens. Weirdly, when we invert this situation, the irrational escalation doesn't occur so dramatically or doesn't happen at all. Notice there is a clear disadvantage here, meaning that it is a lot easier to feel bad emotions while in a losing streak than it is to feel good emotions in a winning streak. The irrational escalation can lead to a state of fight or flight where the trader fully triggers his primitive behaviors, which is something that always ends in disaster. The zero-risk bias is the tendency to prefer the complete elimination of risk even when the existence of alternatives that reduce risk is possible. In general terms, people tend to have a weird relationship with risk, and traders need to deal with this problem in an amplified way. If traders were to always subject themselves to the zero-risk bias, it would be literally impossible to have a successful trading career because these traders would always prefer to avoid taking risks instead of exposing themselves even to situations where risks are significantly lowered. For example, the best a trader can really do is to apply a good methodology, but that doesn't mean risks will disappear. There is no magic about good methods. Their ultimate goal is to reduce risks while providing a framework in which individuals have the possibility to confront themselves with high-quality trading opportunities on a regular basis. Zero risk simply doesn't exist in the financial markets. The returns are always attached to some sort of risk. There is no doubt that risks vary greatly in terms of magnitude, but the absolute absence of risk in trading opportunities is an illusion even if you are remarkably aware of what you are doing in the markets. There is this idea that the more you know about the market, the more you are going to reduce your risks while trading it. That's true up to a point, but it comes a moment where it doesn't really matter how much more you learn about the market or how well you master your technical and psychological tools. Risks simply cannot be reduced to absolute zero. In behavioral economics, the disposition effect is when a person feels the impulse to sell something that has its value suddenly increased and the need to keep something that has decreased its value. In the first case, if a trader has a position in the market that has just crossed the limit between loss and profit to the profitable side, the immediate impulse is to sell such position for a feeling of immediate reward. The whole scalping paradigm is built, among other things, under the disposition effect. This problem gets a little more interesting when we add the second part of the disposition effect, which is the propensity to keep a position in the market if it is on the loser side of the spectrum. Imagine the following situation. A trader opens one trade in the market without a stop-loss and profit-taking order. The trader is simply risking his money based on poor technical motives and perhaps no contextual understanding of the market whatsoever. In this scene, the emotional gauging related to this trade is completely up for grabs and it will probably be involuntarily attached to the objective notions of profit and loss appearing on the trading terminal. This is where the disposition effect clutches the situation and leads the trader through a frustratingly helpless destination, which is the state of being confused about trading, not to count the potentially awful capital losses that can occur. The problem here is that as soon as a trade goes into the positive side, the trader will try to close it acquiring a small profit, but the trader will hold the trade while it's negative with the hope it will come back to the positive side. This is hopeless of course because one trade going bad under this circumstance can wipe out a huge series of small and subsequent profits. The trading ethics in this case are completely the opposite of what they should be. Starting from the fact that not using stop and profit orders in the market is simply too irresponsible. Just imagine the devastating effects of aligning the disposition effect with hyperbolic discounting, the clustering illusion, the overconfidence effect, and all other biases that were presented here for that matter. As soon as we start to look at these things more closely, we can begin to understand how trading psychology is indeed very complicated. The pseudo-certainty effect, as the name clearly suggests, is the tendency to assume certainty when there cannot be. This bias goes hand in hand with the Dunning-Kruger effect because it deals with different levels of certainty based on what an individual knows and this individual's perception about the limits of his knowledge. Pseudo-certainty can possibly appear in the final moments before taking a decision to make a trade. The pseudo-certainty might function as sort of igniter to conclude the whole process of trading investigation assuming there is one. We can never have absolute certainty about the outcome of a trade, but we can have a sense of enough certainty, which is inherently attached to some degree of risk. The problem with the pseudo-certainty effect is that traders who don't have good information about the market will usually display this bias in an exaggerated way. It's always recommended to be skeptical about the markets. Too much certainty can certainly be a problem. The backfire effect is the tendency for people to increase their level of trust in beliefs that have been just faced with contradictory evidence, which is the exact opposite of what should be done, hence the name of the bias. For example, if a trader believes that the stochastic oscillator is a great tool for trading, and another person provides evidence that contradicts that idea, the automatic reaction of the trader is to increase his trust in the stochastic oscillator. Again, instead of being skeptical about it, which is what rationality tells us to do, the trader will tend to take the easier route, or the path of least resistance and let the backfire effect guide his behavior. This is a vicious circle because every time the backfire effect takes place, the deeply held and wired beliefs get stronger and stronger. Reverse psychology is when a person advocates a certain behavior with the opposite quality of what is desired in order to induce another person to act in the way it was desired in the first place. Reverse psychology is the cornerstone of market manipulation, and it occurs every day in pretty much all financial instruments. Market makers are incredibly skillful in employing reverse psychology in the markets because technical analysis presents a simple framework for that to happen, and most of the times, traders need years of study before they get to the point where they learn about this. Market makers can employ reverse psychology in the markets by manipulating price in specific areas to make the market look like it's about to do something, while in reality it's about to do the opposite. The less is better effect, as the name clearly suggests, is the tendency people have for preferring less options to choose instead of more options simply because it's easier. This feeling usually comes from the need to maintain things simple while dealing with complex matters. This is a paradox, of course, because it's impossible to treat a complex system with simplicity at the same time that one expects to understand it correctly. It's paramount to recognize that the need to keep things simple is a mere flaw of our minds, and that reality has no interest in adapting itself to our biases and flaws. It's the other way around. We must adapt our minds to deal with the complexity of reality if we want to understand it better. That's important because traders do this all the time. They get overwhelmed with contextual trading, so they give up on the idea to try something easier. At this point, you can probably imagine what's the result of that attempt. In this lecture, we are going to explore the fifth dimension of our professional strategy, which is called operational logic. This strategy dimension has to do with specific actions a trader can do to manage his trades in a more efficient way. For example, a good operational logic will guide you in the way you put stop losses and profit targets. It will also guide you on how to collapse the risk of a trade and the overall approach on how to manage what you can and cannot do with your orders. In the fractal flow strategy, the operational logic dimension will also tell you simple guidelines that should enable you to be aware of the subtle sleight of hands that the market plays on most traders when we deal with momentum divergence. You will notice that many times in the market, you will be able to find context for both sides. This might force you to choose between one of these sides, which is something that can have diminishing returns. However, before we jump into that, let's see what you can and cannot do with your trade orders. The basic premise of good operational logic is in the name. It's logic. If you want your trades to be managed in the best way possible, you must use sound logic to place your stop and target orders. The reason for that is quite simple. With a logically placed stop loss, you are much less likely to be stopped out if you compare it with an arbitrarily placed stop loss. The same happens with target orders. You have a much greater chance to hit a logically consistent target than a randomly placed target. This idea serves as a filter to open trades. For example, if you have a good context to open a trade, but you don't have a good place to put a logical stop loss order, you simply don't take the trade. That sounds simple, but it can be hard to control the impulse to open a trade when you have good reasons to do it. The same thing works for the target orders, of course. The stop loss order is not just meant to make you stop losing money. It's meant to give you some sort of extra layer of protection. For example, in a long trade, you should place your stop loss a few pips below a solid market structure, which you should be able to recognize from reading the market using other tools of the strategy. Another aspect of operational logic is the ability to collapse the risk of a trade. This is something that can only be done when the trade meets certain criteria. For example, let's say you have a trade that is going well, but you're not sure if it has enough power to hit a minimum risk-reward ratio. If the trade is in enough profitable territory, you can move the stop-loss order to break-even level. The key here is making sure the trade has enough profit, so the natural noise of the market does not hit your stop by accident. One generally accepted rule of thumb is to only collapse the risk of a trade if the profit is equal or greater than the stop in terms of pips. As far as the fractal flow strategy goes, we need to pay attention to a very important detail regarding momentum divergence, which is what makes most people give up on the idea of divergence in the first place. In strong trends, momentum divergence will produce a series of bad signals against the trend. However, most traders gloss over the fact that there is usually a continuation or minor reversal divergence happening in the direction of the trend. These divergences are much subtler, of course, and some of them you can only see with the extra layer of fractal analysis you learned in this course. As a general guideline, you should always pay attention to both sides of the market simultaneously. Instead of trying to catch the ultimate reversal of the markets, try to catch the continuation movements that happen in a subtler way. By doing that, you have a much greater chance of producing profitable trades, and by paying attention to both sides of the market, you usually can trade both sides and be right in one of them. Assuming you are using good risk-reward, if you're correct 50% of the time in your analysis, you will become a consistently profitable trader. By training yourself to be less biased about the direction of the market, it's much easier to develop a better edge against retail traders. Most of the participants of the market are always worried about catching the ultimate reversal. If you want to step away from the herd, you must look at subtler details. These tips and guidelines seem to be almost too simplistic, but they make a huge difference when you start to compound them over time. In the next lecture, we are going to explore the sixth and final dimension of a professional strategy, which is the trade plan. The trade plan is an incredibly important part of trading for a few different reasons. The most obvious of them is the fact that a trade plan enables you to act impulsively and deliberately at the same time. In other words, a trade plan gives you a quick answer to complicated problems about trading. A trade plan has two main sections. The first is composed of the global variables of your trading. In other words, the global variables are the variables that apply to all trades that you are going to be doing. Things like the arbitrary risk percentage, minimum and maximum risk-reward ranges, maximum stop-loss size in terms of pips, allowed timeframes and maximum number of losing trades. The second section of the trade plan is the plan you will need to develop to each individual trade. This is the important contextual elements that we have been talking about so much over this course. There are several ways of keeping track of your individual trade plan. You can take screenshots of your trades before and after they happen, you can write the context of each trade, or you can record a video of the trades you make. This requires some effort in the beginning, but it has extreme value. Going back and seeing what you did correctly and incorrectly in each trade is a tremendously powerful learning tool, far greater than anything else. You will notice that you seem to be one person when trading in real time, and a different person when you analyze what you did in real time. If you followed this course correctly, you already know why that happens. It's because when we deal with economic decisions in real time, a whole array of cognitive biases begin to steer our thought process. On the other hand, when we analyze our trades without being subjected to the unfortunately distorted bounded rationality that trading wakes up in all of us, it's much easier to identify qualities and flaws in our actions. Ironically, this is a way to take advantage of our bias blind spot in a way. As far as the trade plan design goes, it doesn't get much more complicated than this. The difficult part is actually making sure that you will follow this plan religiously. This is the basic framework of a professional trade plan. Keep in mind that every trader has a unique trade plan, that's why we are only providing a framework for you to build your own. In the next lectures, we are going to see the fractal flow strategy come to life in several examples by applying everything we have learned so far in the course. This lecture concludes the theoretical portion of the course. In this video, we are going to see a live example of a long trade performed in the Euro-dollar 5-minute chart. Before we go into the analysis, let's make sure you have the proper chart setups. To identify fractal candles in real time, it is necessary that you use a sensitive setting in the relative strength index. The ideal setting is 4, as you can see in this chart. The first thing we notice in this chart is the upward motion of the market marked from 1 to 6. Notice how price is slowly but surely creating higher highs and higher lows. There is some debate about where the precise points to mark the highs and lows are exactly, which is why these readings can get a little subjective, but for all intents and purposes of this trade, we can agree that it is unquestionable that this market is indeed creating higher highs and higher lows from numbers 1 to 6. Another thing we can notice here is that in each market vector up, the buyers increase their power. Notice the difference in volatility between vector 1 and 2 and the vector 3 and 4. Now look at the difference between vector 3 and 4 and the vector 5 and 6. The market movement between 5 and 6 is interesting to us because it shows an exhaustion movement, which is when price makes a last drive with maximum power, which is what happened in candle 6. Notice also that this candle started with a small gap up, which is another sign that buyers were truly powerful at this point in the chart. Sellers were not even capable of producing small waves in their favor in this area. Take a look at the area where I marked the buyer zone 1. This area comes out of the level in which sellers between 4 and 5 failed to create a lower low than 3. Price peak marked in number 5 is where the buyers picked the control of this market and initiated the vector 5 to 6. We mark this as a significant buyer zone because this was the last place in the chart where significantly powerful buyers showed up. These levels can be useful in the future because of market memory. If buyers showed up vigorously in this level, they might show here again in the near future as long as other contextual elements agree with that premise. After the exhaustion candle marked by the number 6, the market naturally produces a low volatility market that goes in a sideways motion. This is inevitable after a wide candle like candle 6. There was a lot of energy and momentum spent on that candle, so the natural tendency is for the market to pick its energy up again, and it needs a few candles to do that. In the blue arrow down, we can see that the volatility starts to increase for the downside. This makes sense because there is not much buying power up in that level because of that candle 6, so sellers don't have a problem bringing the market down after the blue arrow. This is where the analysis starts to get interesting because now we have sellers going straight against the already proven buyers present in buyer zone 1. Here we have to use our judgment to decide which one of these players is the strongest. The key for deciding which of the market players is stronger in this example is to look at the relative volatility of their movements. Compare the strength of the volatility of the movement between 5 and 6 to the volatility of the movement after the blue arrow down. They are almost the same in terms of magnitude, but the buyers ran the same length in pretty much 3 candles, while the sellers needed about 15 candles to bring the market down to buyer zone 1. That's our indication that buyers are still stronger than sellers in this market even though the market seems to be falling down. When price arrives at the black square 1, we begin to see the fractal flow strategy techniques come into play to solidify the context of our trade. Pay close attention to the details here because they are quite subtle if you're not used to the fractal flow method yet. The area inside the black square 1 is what we call divergent price territory because we can see a clear simple reversal divergence happening in the relative strength index, which is highlighted by the sloping red lines. So far there is nothing special about this because it's only a simple reversal divergence. However, notice that I marked 2 vertical gray lines in the chart. The gray line to the right marks a fractal candle, which can only be identified using the gray line to the left. Pay close attention to the precise alignment between the candle tails and the relative strength index peaks in the 2 gray lines. The left gray line aligns precisely with the peak in the relative strength index. However, the right gray line shows a candle which tail goes lower than the previous candle, and yet the relative strength index marked a much higher value. This is what makes the candle marked by the right gray line a fractal candle. We can see that the candle in the right gray line creates a lower low with its tail while the relative strength index creates a higher low relative to the previous candle. This is the idea of momentum offset we saw in the theoretical section of the course. This basically means there is another reversal divergence happening in a lower timeframe. The great thing about the fractal candle is that we can take advantage of the principle of multi-timeframe analysis without actually needing to shift between timeframes, which is rather inconvenient sometimes. Notice also that this small divergence is happening inside the larger divergence that we identified in the chart earlier with the sloping red lines. This is called a second-degree fractal reversal divergence because there are 2 divergences happening one inside another. Remember the concept of fractal, which is when a pattern repeats inside itself. The second-degree fractal reversal divergence is happening in the area that we identified as a major buyer zone. Notice that we have a few contextual elements working together here to create the idea for the long trade you see on the chart. We are not simply trying to trade divergences without understanding what is going on in the markets. The fractal candle inside this whole context is the signal for you to enter the market in the open of the very next candle. I want you to see the candle interpretation of our fractal candle. Notice it has a clear bullish quality, a large body, and small tails. This can be interpreted as certainty of the buyers about their immediate future direction. Very small seller intervention in that candle, which just adds up on our logically consistent context for this trade. However, before considering the entry for a trade, we still need to know if our trade makes sense in the light of the risk management rules and the operational logic guidelines that we established in the theoretical portion of the course. In this trade, you can see that we have a good place to put a stop loss a few pips below the low of the fractal candle. The reason to place a stop loss there is the assumption that the low of the fractal candle is the absolute low of the market vector that started after the blue arrow down. Beyond that, we have the strong buyers in the buyer zone 1 to help preventing our stop loss to be triggered by the sellers or the natural noise of the market. An even better stop loss placement would be a few pips below the low 5. That would represent a double protection because our stop would be below buyer zone 1 and below the undeniable market structure marked in low 5. However, going for this double protection method all the time can be difficult because the size of the stop-loss order increases, and then you will need to find a larger take-profit order, which will be harder to reach. Speaking of target orders, our target in this trade can be very loose for a very simple reason. If we are correct about our trade context, and the low of the fractal candle is indeed the absolute starting point of the next upward major leg of this market, we have a lot of room to collect profits. In this case, we can simply place a 1 to 3 risk-reward ratio target without any problem. Before we move on to see how the trade ended, I want to grab your attention to something really important here, which is the conflicting nature of the major and minor flows of the market. This is something that you will have to deal with constantly. Notice that our trade is going against the minor and downward flow of the market that started after the blue arrow down. However, by reading the context of the market, we assumed that our fractal candle is pointing to an area where the major flow of buyers will cease the minor flow of sellers, and both flows will ride in synchrony to the upside until the buyer's energy runs out again. Professional trading is all about judging the strength of the major and minor flows, and the precise points where they converge and start to flow together. Notice that if we are correct in our trade context, our fractal candle is giving us pretty good trade location also. Let's see how the market develops. Here we can see that our target is successfully hit. Pay attention to what happened between the opening of our position and the closing of our position. Buyers were obviously stronger, but not too much, so we needed to maintain our orders placed despite the appearance that the trade would go wrong at certain points. As you can see, real-time trading can be counterintuitive sometimes, but we need to stick to our predefined plan. By doing that, we guarantee the integrity of our trading ethic and consistency over the long term. In this lecture, we are going to explore a short trade that happened in the Euro-Dollar 1-hour chart. It's interesting to see the strategy working in different timeframes so you can observe how the timeframe does not really influence the analysis at all. For all intents and purposes, the timeframe you trade should not be relevant at all. The timeframe choice is a tool for you to fit your trading into your lifestyle. The logic behind this is that price action is exactly the same in all timeframes. The only thing that differs is the temporal scale in which trades happen, meaning the time it takes for trades to run their course. Let's begin the analysis of this chart. Once again, this is a difficult scenario because we have conflicting major and minor flows happening all the time, and sometimes this can be a little counterintuitive and confusing. In number 1, we can see a massive bullish candle with a relatively short downward tail, a large body and almost no upper tail at all. The interesting thing here is that the downward tail of this candle is almost the same size as the previous candles. If you look at the candle alone, the tail might not seem that relevant, but if you put it in a relative context like that, that tail begins to look pretty important. The interpretation I get from this downward tail is that there were some sellers near the opening of this candle, but they certainly got smashed by the overwhelming power of the buyers in the candle. From 1 through 4, you can see that the market creates a higher high in 4 and a higher low in 3. Number 3 is solid market structure at this point because 4 closes above 2. However, between 4 and 5, a rather sinister game plays out in the market. Notice that price pierces the low number 3, but it never closes below it. This makes the high number 4 a fake market structure. Once price starts to create minor highs and lows after number 5, we can confirm this was probably a market manipulation. We are not going to go in greater detail about that now because the mechanics of such manipulations require a course on their own. All we need to know for the fractal flow strategy is that 2 through 5 is an expanding pivot formation, and an expanding pivot formation like this means a significant area for buyers to appear again in the future. Notice that after number 5, price goes sideways for about 10 candles, and then it begins to increase volatility to the upside. This is where the black rectangle is drawn to extend the area where buyers decided to bring the market up after the probable manipulation in number 5. The market between number 5 and 8 is nothing special other than it is maintaining its major uptrend. Things start to shift a little bit in the market vector between 8 and 9. By the way, at the very top of highs 6 and 8, fractal candles appear to pinpoint the imminent reversal. However, don't even think about trying to trade those candles on their own without context because you will get burned repeatedly. Look at what happened between 8 and 9. Price goes precisely to the solid market structure marked in number 7. We know 7 is solid because 8 closed clearly above 6, so there are some buyers around number 7. Notice that candle number 9 is a fractal candle as well, and you could have been tempted to place a long trade right after candle 9, and you would be correct because there was in fact some context for a long trade there. It would be a legitimate trade. The only problem is that it is in the middle of a flow shift in the market, so the trade would have been stopped out, which is fine as long as you placed the stop loss right below number 9. By the way, this is what a losing trade in the fractal flow strategy would look like. You would be stopped out, but your stop would be small, so it would not hurt so much. Notice also that candle 9 has an interesting shape. It has a small body and a large downward tail, which means there were indeed some buyers in the low number 7. Once again, the key to anticipate the flow shift here is to look at the volatility of the movement produced by buyers and sellers. Look how strongly the sellers come down between 8 and 9 and look how weak the buyers are after candle 9. The market movement between 9 and 11 is where the flow shift occurs. After 9, buyers attempt to begin their rise to break high number 8 and create a higher high and solidify number 9 as undeniable market structure. However, as you can clearly see, they absolutely failed to do that in number 10, and sellers picked the control of the market after number 10, broke down the low number 9 and created a solid market structure in number 10 as a confirmed high. In 10.1, you can see that buyers from low number 9 attempt to stop the sellers once again in a bullish fractal candle. This is valid long trade setup if you look at the market objectively. However, after high number 10, you should be able to recognize that buyers were not really in control of the market anymore. This is why subjectivity is important in our analysis. This idea of who is in control of the market is hard to reach by purely objective terms. In 10.2, we have another interesting fact. The market goes up to the turning point on high number 10, which is marked by the upper line of the black rectangle, but it creates a fractal candle down right after the fractal candle up in 10.1. This is an indication that sellers are not willing to give up the recently acquired control of the market that easily. You can see that the market drops violently after that. The narrow black rectangle between 10 and 10.2 is the area where sellers really proved their point to the buyers. Notice that the upper line of the rectangle comes out of the turning point from 9 to 11, and the lower line of the rectangle comes out of the high of that fractal candle down. In number 11, we see the market reaching the major buyer area we marked in number 5. Once again, price is producing a fractal candle with a large downward tail. You could consider buying here as well, and you would be correct. The trade would not be enough to produce a 1 to 3 risk reward, but it would be certainly enough to collapse risk and get out of the market unharmed. From number 11 on, things start to get even trickier. Notice that in number 12, the market almost reaches our narrow black rectangle of sellers, but it produces a fractal candle a little bit earlier. Once again, acceptable short trade idea here, and this one would clearly be good if you placed a stop loss right above the fractal candle number 12. Easily a 1 to 4 risk-reward trade. However, I want to show you the difficult trade on the chart. Notice that the sellers between 12 and 13 were not able to create a lower low than number 11. This is a problem for us here because now we have to decide who's stronger in the market. The buyers from number 5 or the sellers from number 10. At this point I would say that it's almost impossible to tell who the strongest player is here, so we need to rely on other details to enter a trade. After low 13, notice that price creates a huge bullish candle that stops right in our narrow black rectangle that's coming out of the flow shift point in number 10. That's obviously a scary place to go short because of the sheer violence of that huge bullish candle. However, notice that our narrow black rectangle hasn't been violated yet and price creates a fractal candle down in number 14. Here we have a fractal candle happening inside the already divergent price territory marked by the blue rectangle. We have all the elements to go short in the open of the candle next to the fractal candle 14. We have solid market structure as a double protection in number 10, which happens to be the flow shift level of the sellers, and we have a second-degree fractal reversal divergence happening exactly in our narrow black rectangle. The only thing that could stop us from opening this short trade was the size of that bullish candle right before the fractal candle down in number 14 plus the fact that sellers failed to create a lower low than number 11 in the vector between 12 and 13. However, this seems to be a pretty even battle between buyers and sellers, and that massive bullish candle before the fractal candle 14 could be an exhaustion movement. Beyond that, if we look at the space between market vectors, it seems like this market is in sideways mode between 11 and 13. This is a difficult trade because there is no way to know which of the market players is indeed the strongest. This is where we have to assume risk and count on a little bit of luck to help us, despite how juvenile that may sound. I say that because we have the elements to open a short trade, but we could absolutely be wrong here, so we have to literally risk ourselves and see what happens. After all, there is no profit without risk. The short trade you see opened in the chart was triggered in the open of the candle right after fractal candle number 14. The stop loss is not only above the fractal candle number 14, but is also above the high number 10, which was a key moment in this chart and the origin of the flow shift to the seller side. The target was placed down in the ignition point marked in the blue line number 1. If sellers are indeed stronger than buyers in our trade, the market will have enough strength to go down to that point. Our stop loss is about 20 pips and our profit target is about 87 pips, which gives us a 1 to 4.4 risk-reward ratio. Let's see how the market develops. Here we can see the market reaching our desired target. It's important that you review this trade a few times because it's hard to catch all the details at once. Trading does not get much more difficult than this, so if you can get used to this level of analysis, you will be well on your path to become consistently profitable. In this video, we are going to look at a simple trade that was rooted in the fractal hybrid divergence idea. Just as a reminder, the fractal hybrid divergence is the combination of a hidden divergence in a higher timeframe with a reversal divergence in a lower timeframe. The higher timeframe is the current timeframe we are analyzing. The lower timeframe would be the next lower timeframe, which in this case is the 5-minute. Since we have the fractal candle concept under our belt, we don't need to change timeframes to see that reversal divergence happening. We can do it all from only one timeframe. The fractal hybrid divergence idea can be a little confusing at first, so we are going to look at a trade that has a simpler context around it. In number 1, we can see a very wide bullish candle that apparently initiated the downward trend we are seeing in this chart. Notice how price explodes down, and then it starts to create more reliable and balanced movements from number 2 to 7. As I said in the beginning, there is nothing especially challenging about this market. Sellers are just creating lower highs and lower lows between number 2 and number 7. However, in number 7 things get pretty interesting because we begin to see a bearish hidden divergence happening. A bearish hidden divergence simply means that the market will continue to go down. We identify this type of divergence by comparing the highs of the relative strength index with the highs of price action. Notice that number 7 is a lower high than number 5. In the relative strength index, number 7 is a higher high than number 5. That's a discrepancy in momentum because if price and market momentum were in alignment, high number 7 should be lower than high number 5 in the relative strength index. That's just a simple hidden divergence marked by the sloped red lines in the chart. The really interesting thing about this trade is that in number 7, a fractal candle appears. Pay close attention to the precise alignment between candle 7's high with the high of the previous candle. Now take a look at the momentum offset between these two little highs in the relative strength index. This is a small reversal divergence happening in a lower timeframe. The fractal candle number 7 also happens to be in the turning point of market vectors 4 through 6, which was the last time sellers appeared in the market to create the movement between 5 and 6, as you can see by the horizontal blue line. The short trade you see in this chart was triggered at the opening of the candle right next to the fractal candle number 7. Since we are dealing with a fractal hybrid divergence with a clean context, our stop loss can easily be placed a few pips above the high of our fractal candle number 7. We also have a lot of headroom to place our target, but we are going to place it in the lower line of the lower orange rectangle. These two orange rectangles are also very simple. The higher rectangle just captures the range of the last movement produced by the sellers, which was the market vector between number 5 and number 6. The lower orange rectangle is equidistant to the higher orange rectangle. This is vaguely based on the Newtonian idea that every action has an equal and opposite reaction. The market vector between 5 and 6 is the action, and the lower line of the lower orange rectangle is our expected reaction for this movement. Our stop loss is roughly 10 pips and our target is about 30 pips, which gives a nice and realistic risk-reward ratio. Let's see how the market turns out. Here we can see that our trade hit the desired target. Notice how the market misses the target and then comes back near to the entry point of our trade. This is a situation in which a trader must remain psychologically strong and keep the trading orders where they are supposed to be. A lot of traders see price missing the target and coming back, so they get desperate and close the trade with a small profit. That seems like a good idea in a first moment, but it's deadly in the long term, as we observed in the other portions of the course. Hopefully you were able to see the simplicity of this trade. Not all trades are tricky and complicated to make. Some of them are quite simple, like this one, which is a relief for less experienced traders. In this video, we are going to look at an example of a third-degree fractal hybrid divergence in the 15-minute timeframe of a rather exotic currency pair, which is the Australian dollar versus the Japanese yen. I want to stress out once again that it doesn't matter the instrument or the timeframe we apply the fractal flow strategy. The analysis is exactly the same. I'm showing you various examples in different markets and timeframes to prove that point to you. From numbers 1 to 3, we can see a major market movement formation. Number 3 is a confirmed solid market structure since the market obviously broke it to the upside. However, notice that from number 3 on, the market enters in a stair-stepping up motion in its minor flow. I want to grab your attention to a trade idea that could have been taken in this chart between number 4 and number 7. Look at how simple this trade idea is. Between number 4 and number 7, the market is gently creating higher highs and higher lows. Notice that number 7 is a fractal candle that landed in the turning point line of the market vectors between 4 and 6. We have a solid minor market structure in number 5, which would have been a perfect place to put a stop-loss order with lots of headroom to collect profits up. Notice that fractal candle number 7 is also an outside candle, which is just icing on the cake for this long trade idea. Another important detail here is that our fractal candle happened inside a hidden divergence, which makes this a second-degree fractal hybrid divergence setup. This is as perfect as it gets in terms of second-degree fractal hybrids. As usual, the stop-loss could have been placed a few pips below the fractal candle or a few pips below the solid market structure in phi for a double layer of protection. However, this video is about the third-degree fractal hybrid trade you see opened in the chart. I just wanted to show you this extra example because it had such a perfect formation. Back to our analysis for the current trade, we can see that from number 4 to number 8, the market creates nice minor higher highs and higher lows. From number 9 to number 10, an interesting thing happens. Notice that in number 10, the market attempts to create a higher high than number 8. Price gently pierces the high number 8, but it never closes above it, which makes the low number 9 a fake market structure. The logic behind this idea is that the buyers that were responsible for the market vector between number 9 and 10 were not strong enough to surpass high number 8, so we cannot be sure about their strength in this point. Notice also that there is a fractal candle in number 10 that is happening in the divergent price territory above number 8. Very obvious short trade setup, but since we are dealing with a clear uptrend here, this would be a quite dangerous trade to take. As you can see, even with this dangerous trade idea, you could get away with it, and you could even get a nice risk-reward ratio out of it. However, you must resist the temptation to take these sorts of trades for reasons that should be pretty clear to you at this point. In number 11 is where the subtle details happen to solidify the current long trade idea. Just as a parenthesis, if you were a trader that was aware of divergence, but not aware of fractal divergence, you would miss this opportunity completely. As we can see here, there is a hidden divergence happening between low number 7 and the potential low number 11. We are only considering number 11 as a low because of the fractal hybrid divergence. Notice that before number 11, I drew 3 gray vertical lines on the chart. If you pay close attention, you will see there is a reversal divergence happening between the 2 outer lines marked by the sloping short red lines in price and in the relative strength index. There is also another reversal divergence happening between the center gray line and the right gray line, which is our fractal candle number 11. This is marked by the tiny sloping blue line in price and in the relative strength index. These three divergences can be classified as a third-degree fractal hybrid because in the larger fractal, we have a clear hidden divergence. In the lower fractal marked by the sloping red lines, we have a reversal divergence, and inside this reversal divergence we have another reversal divergence signaled by our fractal candle number 11. This is a great example to prove how important it is to pay attention to the precise alignment between candles' tails and the peaks of the relative strength index when the correct time comes. You might be wondering what other contextual elements we have to trigger this long trade idea other than the third-degree fractal hybrid divergence. Since we're dealing with a minor flow here, we can say that the last time successful buyers appeared in the market was in low number 7. Here is where we reach one of those situations where we need to take unknown risks. We are too far away from low number 7 to place a stop loss there, but we have a third-degree fractal hybrid divergence happening in the same level as a minor consolidation marked by the red rectangle between 7 and 8. Beyond that, the horizontal black line that is coming out of high number 6 is a support and resistance line that is meeting the low of our fractal candle number 11 almost perfectly. Notice also that inside the red rectangle there are 3 candles. The first one zooms the line coming out of high number 6 with a certain volatility that cannot be found in the surrounding candles. Our fractal candle number 11 seems to be the first test of the support line that used to be resistance. Our only choice to place a stop loss here is a few pips below the fractal candle number 11. The long position you see on the chart was triggered roughly in the opening of the candle next to the fractal candle number 11. As far as our target goes, we are going to take a different approach and use a dynamic target. Notice that we have an upsloping black line that comes out of number 7 and connects to the low of our fractal candle 11. We extrapolated this line and placed in the high number 8, which seems to be the outer edge of this market up to this point. These two lines have the exact same angle and they serve to delineate future extremes in price. We will talk a lot more about these types of lines in the Pitchfork Master Strategy and in the Hidden Lines Strategy courses. For the purposes of the fractal flow method, you could simply double the range of the vector between 10 and 11 to form a target, or you could use any logically based place to give you at least a 1:3 risk-reward ratio on this trade. However, as I said earlier, I want to give you a taste of how a dynamic target works in real time. The idea behind a dynamic target is that the longer you stay in a trade, the more you should be rewarded since we are increasing our risk exposure. By attaching your target to an upsloping line in the case of a long trade, the longer you are in the trade, the greater your target will be. You just have to update your target order in each candle opening. The target should be placed in the intersection of the current candle with the upsloping black line coming out of number 8. Notice that the initial risk-reward ratio of this trade is about 3.8. However, if we happen to be correct in our analysis, our dynamic target will give us the opportunity to close this trade with an even better risk-reward ratio. Let's see how the market develops. Here we can see that we successfully hit our target. By the way, look at how much our target increased with that dynamic upsloping black line guiding our order. Our trade began with a 3.8 ratio and closed with a 5.7 risk-reward. This is the power of dynamic targeting. I also want you to notice that the lower upsloping black line that we drew from number 7 and connected to our fractal candle number 11 served as a sloped support for the market, which touched the line 3 times. There are situations where lines like this can be used as a secondary entry, or an auxiliary entry in case you missed the first one. I would say this trade is more of an intermediary level because it required that we assumed some dangerous ideas like relying on a minor consolidation to ground our stop-loss idea despite having a pretty good fractal hybrid. Hopefully you were able to enrich your level of understanding of the fractal flow method with this example. In this video, we are going to look at a long trade in the US dollar against the Canadian dollar using a second-degree fractal hybrid divergence in the 30-minute timeframe. In number 1 we can see the last confirmed high that was created by the same sellers who produced that massive drop in the market a few candles back. At this point it's clear that sellers are not nearly as strong as they were in those 2 highly volatile candles. In number 3, we see a new pack of buyers trying to disprove this market by attempting to break the last confirmed high where sellers showed up significantly for the last time. Sellers managed to create a bump back down in number 4, but buyers picked the market up again quickly and broke the high number 1. I want you to notice how organized the movement between 4 and 5 is. Look at how every candle produces a higher high and a higher low. This is suspiciously organized, and it might be the product of some market maker trying to trigger retail traders to go long in a bad trade location or trying to trigger stop orders that were above high number 1. Notice also that now the market is creating higher highs and higher lows, so it makes sense to look for optimal places to go long. Another important detail here is that the next significant pack of sellers that might hinder a long trade idea is relatively far away, and it is around the opening of the first massive candle down. As far as the momentum analysis of the market goes, notice that between 4 and 6 we have a simple hidden divergence marked by the short red lines. Number 6 happens to be a fractal candle, as we can observe by the offset between the lows from candle 6 and its previous candle, and the corresponding peaks in the relative strength index. Once again, we are only considering number 6 as a potential low because of the second-degree hybrid divergence we are able to see here. Beyond that, we see that the tail of the fractal candle number 6 landed exactly in the supply and demand zone that spiraled from the turning point between 2 and 4, and then from 3 and 5 marked by the narrow black rectangle. Another interesting fact about the market vectors between number 2 and number 6 is that the retracement between 5 and 6 is approximately the same size as the retracement between 3 and 4. Since we are dealing with an organized and clear market up to this point, this observation adds up to our long trade bias. Notice also how the narrow black rectangle acts similarly to a support and resistance line. These are called supply and demand zones, and the logic sustaining such idea is simply the determination of zones where buyers and sellers shift the control of the market. This is a very simple trade idea because this market is quite clear and noise-free. Our current long position was triggered in the open of the candle right after the fractal candle number 6 with a stop loss a few pips below number 4 for a double layer of protection. Our target was placed in the blue horizontal line coming out of that candle with a large upper tail on top left corner of the chart. Notice that before our trade can have a free pathway to hit that target, the buyers on which we're counting must be strong enough to surpass the ignition point of that first massive bearish candle marked by the horizontal black line. If this analysis holds up, we will be looking to collect a nice 1 to 4.5 risk-reward ratio trade, which is well within the realistic range we established by looking at the logarithmic nature of the margin of error increments. If you have been paying close attention to the trade examples in this course, you must have noticed that the combination of contextual trading with our unique approach to momentum analysis of the market is indeed critical to pinpoint the precise turning points of the market. One of the most difficult things to do as a trader is trying to know when the market is going to turn. Contextual trading aligned with the careful and clear-cut observation of the relationship between raw price action and momentum really makes the difference in the trade location aspect of a strategy. Let's see how the market develops. Here we can see the market hitting the target for a nice and simple trade using a second-degree fractal hybrid. A couple of interesting things I want you to notice in the market is the point number 8. Notice that between market vectors 5 through 7, the market created another crystal clear higher high and higher low, with 6 being a confirmed and solid market structure. We have a blue horizontal line that shows the turning point of the market vectors between 5 and 7. Candle 8 landed precisely in that turning point line. Notice also that in point number 8 we didn't have a fractal candle, but we did have another simple hidden divergence between 6 and 8. I am showing you this because fractal divergences do not happen in all minor and major turning points of the market. That's just a practical reality we need to deal with. However, there are other ways of triggering a trade without necessarily having a clear fractal candle, but we must be very careful with this idea. I want to grab your attention to the idea of clear momentum turns. Pay close attention to the market vector between 7 and 8. Notice that this was a perfect downward movement. Every candle creates a lower high and a lower low. In the relative strength index, we also have a downward line without any cracks, which reflects the perfect nature of our little market vector between 7 and 8. Notice that the very next candle after number 8 is a candle that completely breaks the perfect pattern between 7 and 8. It doesn't create a lower low, it creates a small higher high in the candle level, and the relative strength index begins to point up. When we have a break of a perfect price and momentum pattern like that, we can consider entering the market if we have other contextual elements supporting our trade idea, of course, which is clearly the case in number 8. We have the candle number 8 landing in a turning point line. We have a pretty good place to put a stop-loss order under solid market structure number 6. We have a clear simple hidden divergence happening and the market is obviously creating higher highs and higher lows in the major scale. Notice that candle 6 was also an obvious break of the perfect market vector from 5 to 6. However, be very careful with this idea because you might want to apply it everywhere without considering the proper contextual elements. More to the right of the chart, you can see a candle marked by the number 9. Notice that this candle plowed through the point of ignition of sellers we marked in the far left of the chart. Notice how easily buyers broke that level. This should give you a pretty good idea of who is in control of this market at this point. This was another simple example of the fractal flow method application in a clear market. Hopefully you were able to pick up the subtle details and nuances of the fractal flow method, and how they make all the difference as far as precision goes. In this lecture, we are going to analyze a short trade in the euro against the British pound 1-hour timeframe using a third-degree fractal hybrid divergence as a core setup with the proper surrounding context. The deepest degree of our fractal hybrid is quite subtle in this case, so pay close attention to the small details in the chart. In number 1, we have an ignition point for buyers that brought the market up to number 1.1. Right after this point, the market starts to cascade down to meet the ignition point number 1. I want to grab your attention to how precisely the market tests the ignition point 1 by the blue arrows near number 2. This is a perfect example to show how these points of ignition in the chart serve as supply and demand areas. It has a massive volatility that cannot even begin to be compared to the surrounding candles. We must be careful with these highly volatile candles because they might be two different things. They might be just a large pack of buyers exhausting their energy, or they might be market makers doing their thing and trying to distract the rest of the market. At that point it is pretty much impossible to recognize which of these two alternatives we are talking about in this chart. From 1.1 to number 2, we have the cascading sellers attempting to break low number 1. Observe that the sellers fail to create a lower low than 1, and the buyers pick up the control of the market from number 2.1 on. Notice that those large downward tails around number 2 show the fight between buyers and sellers. Observe also how volatility increases after the market reaches the point of ignition number 1 if you compare it to the beginning of the market vector from 1.1 to number 2. 2.1 is the moment where buyers won that battle, as you can see by the marked fractal candle. In number 3 is where this market starts to show its rather interesting character because the buyers who just won the flow attempt to make a higher high than 1.1, but they end up being unsuccessful. Those apparently shy sellers from market vector 1.1 to number 2 began to show their true power in candle 3.2. This candle is easily the largest candle on this chart. Beyond that, it is probably twice as big as the second largest candle on the chart, which was candle number 1, which also happened to be the candle that gave origin to the point of ignition of the buyers who were apparently in control of this market. Candle 3.2 is a very explicit way of sellers telling buyers who is in charge of the market now. It could not be more explicit than that. Observe also that beyond the massive range of candle 3.2, it breaks the ignition point number 1 and the low number 2, turning the high number 3 into solid market structure. Sellers ended up creating a few more candles that made the market fall even more down to number 4, which is where the buyers picked up the control of the market again. In 4, the sellers were completely exhausted, so it makes sense that smaller buyers take control of the market temporarily until something new happens. We can see the buyers doing their thing by the creation of higher highs and higher lows in what appears to be the minor flow of this market. Just compare to the strength of the major flow of sellers going down from number 3. The market starts to go up and meet the green zone that was drawn based on the market vector from 3 to 4. The upper line of that green zone is in the ignition point of the candle 3.2, and the lower line of the zone is in the turning point line between 2.1 and 4. Roughly speaking, this is where those powerful sellers might show up again based on the context we have so far. Let's now move on to the momentum analysis of the market. At this point you might have been able to identify that there is a very clear hidden bearish divergence happening between high 3 and the potential high 5. A hidden bearish divergence means the market will continue to go down. We identify that by looking at the relationship between market highs and the relative strength index. The potential high number 5 is undeniably lower than high number 3, and yet the relative strength index is showing the opposite. In terms of momentum, potential high number 5 has greater upward momentum than high number 3. The simple hidden divergence is of course the gateway for us to observe the other subtler divergences happening in smaller degrees. Observe very carefully the details of the lines drawn around number 5. We have 3 gray lines. The 2 outer gray lines point to the second degree of our triple divergence. Compare the high of the candle in the left gray line with the high of the candle in the right gray line. The candle in the right gray line is like 2 ticks higher than the candle in the left gray line. If we compare these higher highs relationship to the momentum in the relative strength index, we will be able to observe a simple reversal divergence. Let's not forget that this reversal divergence is happening inside the larger hidden divergence, so this is already a second-degree fractal hybrid. However, we have a third reversal divergence happening in the outer right gray line. Notice that the candle marked by the right gray line has a higher high than its immediately previous candle, which is marked by the center gray line. If we look at the relative strength index again, we can see that the peaks are showing a lower high between the center gray line and the right gray line. This is our third divergence in this example, making this a third-degree fractal hybrid. This is as perfect as it gets in terms of fractal hybrids. Observe also that this third-degree fractal hybrid is happening inside our green rectangle that points to the area where the powerful sellers from candle 3.2 might show up again. We also have a pretty good place to put a stop loss above high number 3, but we could also place it above the upper tail of our fractal candle number 5. Our target also seems to be pretty obvious in this trade. The low number 4 represents a potential place for buyers to show up again, although that seems a little unlikely due to the overwhelming power of the sellers from number 3.2. The trade you see opened in the chart was once again triggered at the opening of the candle right after our fractal candle number 5. Remember that it's important to work only with closed candles when we deal with divergence. Let's see how this market turns out. As you can see, our trading context was correct and the third-degree fractal hybrid divergence gave a precise signal for us to enter the market. Notice how all the elements of our trading context align themselves perfectly. They almost give a sensation of certainty to enter a trade, which is good when we need to assume risk in the markets. In this video, we are going to look at a dangerous trade idea in the British pound versus the Japanese yen. I want you to pay attention to this trade because it's a good example of something that you should not do, or at least something you should approach very carefully. I'm saying this because a dangerous idea can turn out to be a profitable trade, which just makes the idea even more dangerous. This particular trade is also a little more dangerous because it is on a high time frame, so the stops will be larger, and the trade will take longer to complete. This has some effects in the psychology of a trader. The essential point here is that if you don't have an almost perfect reason to enter a trade like this, just don't do it. There are plenty of other easier opportunities to take in the market, and they are quite frequent also, so there is no point concentrating on danger. From number 1 to number 11, we see the pound-yen creating higher highs and higher lows in a pretty well-organized fashion. There are some scary candles like number 6 for example, but nothing in this market is telling us it will give us a short trade opportunity. If anything, you should be looking for opportunities to go long in this market. Newtonian physics tells us that there must be an external force to stop the momentum of this trend. At the moment, it has its own inertia and there is no rule that tells us that it should not continue to go up much higher. Observe that I drew several horizontal blue lines in the chart representing the turning points between market vectors. Notice how perfectly the market lands on these turning point lines in number 6 and in number 8. Also notice that in number 10, the market didn't landed on the turning point line drawn between market vectors 7 through 9, but it landed on the support and resistance line that comes out of number 7. Number 6 and number 8 are valid long trade opportunities because we have the context of a stair-stepping market landing on a turning point line with a fractal candle to nail the coffin. As I told you before, I want to show you the dangerous idea here. Those trades in number 6 and number 8 are just perfect ideas, and there is nothing challenging about them. Another thing I want to show you here is that up-sloping red line that was drawn from number 2 to number 4 connecting several low tails together. Look at how perfectly the market goes back to that line a few times after that in number 6 and number 8. There are 13 candle tails touching that line, which makes it a quite powerful line to use in a context. However, that's a subject for another day. Let's bring the attention back to our irresponsible trade. Observe that in number 11, we are experiencing a simple reversal divergence marked by the short blue lines between 9 and 11. That's not a big deal because we also have a simple reversal divergence between 7 and 9. This is where traders start to give up on the idea of divergence, and with good reason, because the relative strength index will produce a series of bad signals and traders will get burned time after time. However, if you are aware of fractal divergence, you can control this idea more precisely. If you were to go short somewhere around 9, you would at least wait for a fractal candle to appear, so you would not feel so reckless taking a short trade in a clear up-trending market. Notice that fractal candle 9 produces a quite nice pullback to number 10. However, as it is usually said, the devil is in the details here. Let's look at the attributes of candle 9. It's relatively the same volatility as the previous candles. It has a small body and large tails. If we try to roll back the chain of causality of that candle, we will arrive at the conclusion that there was some internal fight between buyers and sellers, and that the winner of that battle didn't really win by a large margin. The candle has a bearish quality to it, but as you can see, it's not that strong. By looking at these details you can see how going short in candle 9 would not be the best idea ever, but you could get away with it due to the precision of the fractal candle. Candle 11 is a similar situation momentum-wise, but the candle itself tells a completely different story. Candle 11 is a fractal candle, as you can see by the short red line in price and in the relative strength index. Beyond that, look at the attributes of the candle itself. It has a higher volatility than the previous candles. It is an outside candle, which means it is fully encapsulating the last candle. The logic behind that outside candle quality is that the dominant player in candle 11, which were the sellers, were not only strong enough to stop the buyers from bringing the market up, but they were strong enough to create a lower low than the previous candle. Look at the upper tail of candle 11. It implies there were some buyers up there, but they clearly got smashed down. Now look at the downward tail. It barely exists. This shows a kind of certainty of the sellers in this case, not to mention the large bearish body of the candle. If we compare candle 11 interpretation with the candle 9 interpretation, we will notice that they are quite different. The short trade you see in this chart was triggered because of the candle attributes of candle 11 in comparison to candle 9, plus the second-degree fractal momentum divergence we have here. However, this is clearly going against the main trend of this market as far as we can see up to this point. This is why I'm warning you that you might get away with this stuff once in a while, but it is usually a bad idea to go against the trend. However, there is nothing impeding candle 11 to be the beginning of a downward movement. It's just not very wise to look for the absolute market reversals like that. Trading is already pretty difficult with the relatively easier contexts. The only possible logical place to put a stop loss in this trade is a few pips above the high of fractal candle 11, because if this is indeed a good fractal candle, the market will not spike its high, and it will produce at least a reasonable retracement down. The target can be placed anywhere where buyers might show up, as long as it gives us a good risk-reward ratio. I just placed the target in the turning point line between market vectors 1 and 3. Let's see what happens next. This is a situation where we have to be very careful because a trade like this can easily trigger a trader's overconfidence bias, which will inevitably lead to disaster. I hope you are able to see the bigger lesson here, and understand the heavy temptations that are attached to this kind of trade. I hope that you also learn to resist these heavy temptations. This was a 270 pip trade in the 4-hour timeframe. Just imagine how satisfying that can feel. Remember that this feeling of satisfaction has a rotten and malicious nature underneath it, and it will attack you in the first chance it gets. I'm showing you this, so you don't have to go through this experience yourself. Some say that wise people learn from the mistakes of others, so I hope this serves as an inspiration to you. In this video, we are going to analyze a long trade idea in the euro against the Japanese yen 1-hour timeframe using the third-degree fractal hybrid divergence once again. These examples using the fractal hybrids are good because they serve to show not only how fractal hybrids occur, but also how second-degree fractal reversals occur. In this chart, you can see that the euro-yen created higher highs and higher lows from number 1 to number 4. However, the market vector from number 4 to number 5 creates a confusing fact in the chart. Observe that low number 3 is solid market structure, but number 5 violates that low and does not close below it. This makes high number 4 a fake market structure. Market makers usually do this type of maneuver to induce retail traders to sell at the break of low number 3. Once that happens, market makers take the exact opposite position and bring the market up, making all those retail sellers enter in negative territory. Notice that this market manipulation still agrees with the idea of an upward trend that comes from those higher highs and higher lows we identified. From 5 to 6 we can see that the market clearly breaks the high number 4 and turns number 5 into a solid market structure. As a parenthesis, I want to bring your attention to a subtle detail on this chart. Take a look at number 5.5. Observe how that upsloping short green line touches on the lower tails of those candles. This is a fingerprint of market makers who have a specific agenda to not let this market go lower than a certain point, which in this case is that green line. Every time the market touches the green line, market makers increase their position to the upside. This situation is usually known as a market press. Going back to our analysis, after 6 we can see the sellers controlling the market because the buyers exhaust their power in that last volatile candle number 6. Since we are dealing with a major upward flow from 1 to 6, it makes sense to look for long trade opportunities. The last time that significant buyers appeared on the chart was in the turning point line between vectors 4 and 6, which is marked by the black horizontal line coming out of candle 5. This is not only where major buyers appeared, but it is also where market makers washed thousands of retail traders out of their short positions. In terms of the momentum analysis, we have a very obvious hidden divergence happening between number 5 and potential low number 7. We also have a simple reversal divergence happening in the lows marked by the short red lines, and a fractal candle marked by the shortest green line. Notice that candle 7 and the previous candle form a double bottom. Candle 7 is not really lower than the previous candle. Their lows are exactly the same, but look at the difference in the momentum measured by the relative strength index. This is a good context to go long in this market. We have a good place to put a stop-loss order below our fractal candle and lots of potential to go up. The trigger point is the open of the very next candle to candle number 7. The target was placed a few pips below the high number 6 because that was the last stretch of the buyers on which we are relying on, and if we are correct about this uptrend, price will have no difficulty surpassing that point. Let's see how the market develops. As you can see, the market hits our desired target. This was also a textbook example of the fractal flow method, and how all contextual elements end up pointing to a single place in the chart. From these 8 live trade examples, you can get a pretty good idea of what the fractal flow strategy feels like, and the types of clues you should look for in the charts. You should also have a pretty good idea of how to start your analysis. These 8 examples close the fractal flow strategy video course. Hopefully, you were able to learn something useful with this material. If you have any sort of question about the strategy or the markets in general, do not hesitate to contact us at any time. We will be more than happy to help you until you find some benefit from the strategy. There are incredibly valuable lessons here, and it is advisable that you watch all the lectures several times to catch every important detail. Thank you for putting your trust in this product, and I hope you can apply it to your own trading in its full potential.